U.S. stocks treading water, U.S. Treasuries pushing higher, and emerging markets getting their mojo back. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to closing bell here in the U.S. with about 2 hours to go. You're looking at an S&P 500 that's pretty much unchanged at the moment. We had been looking at gains earlier in the day. Of course, we had some Fed speak suggesting that maybe the Fed is comfortably positioned right now. Then we got a pretty weak Treasury auction at 1 p.m., those 7-year bonds not exactly going over too well. You can see that took some of the sentiment out of stocks. Yield still down on a net basis right now on the day. The 10-year Treasury yield lower by about 3 basis points, though we were lower in the section before that sale. And I did want to highlight the dollar as well, not catching a haven bid. The Bloomberg Dollar Index off by about 0.4%, Romaine. Yeah, a lot of price action today, but of course, some of the most exciting price action, once again, you're going to find it in the Treasury market. A resumption of the price rally that has now pushed the 10-year yield back down to 4.3%. And the latest weekly client survey conducted by J.P. Morgan for the week ended November 27th found that 78% of active clients were now positioned long Treasuries relative to the benchmark. That's up from 56% the previous week. Not a single one of them was positioned on the short side. Now, one reason for that may be expectations that not only are the Fed hawks retreating, but the doves might actually be ready to spread their wings. Fed Governor Christopher Waller speaking today saying he's encouraged by recent slowing of economic activity, which may indicate Fed policy is tight enough to contain inflation. Meanwhile, we heard from Chicago Fed President Austin Goolsbee speaking at a separate event, and he also cited progress on inflation, particularly outside of the food sector. But Fed Governor Michelle Bowman, a bit of an outlier here, saying that additional tightening of monetary policy might still be needed to return inflation to the Fed's target. Now, Bowman at this point may prove to be an outlier as investors here in the U.S. and abroad are repositioning their asset allocation around the idea of a more dovish Fed. Exhibit A, emerging market stocks looking to extend their winning streak now to a 5th straight week as inflows into EM ETFs, Katie, I know your ears just perked up there, topping $10 billion so far this year as traders trace one of the biggest valuation discounts out there. And I got to say, it's not just EM stocks that are on fire right now. It's really across EM assets. If you take a look at bonds, currencies, and equities in emerging market, it has really been a bumper month. In November, you can see that all three gained, and that followed several months where you saw really sort of all of these assets declining. But definitely the tone shifted in November for emerging markets and really around the globe. If you take a look at a global index right now, putting together a 4th straight week of gains last week, it looks like maybe this week will continue. But again, this is really a global story, this re-energization of the equity market that we saw around the globe in November. As you can see, 4 straight weeks of gains. We haven't seen that since last summer, Romaine. So we'll see how this week goes, and then we'll see how December goes.
All right, let's kick things off here to the close with George Patterson, Chief Investment Officer over at PGIM Quantitative Solutions. George, great to have you here. And let's start off with the trade in EM right now, which has really kind of revitalized itself. I mean, I'm sure you know the start of the year we had that big rally, kind of petered out during the summer. What's kind of behind this uptick that we've seen over the past few weeks?
Thank you very much. Great to be here. Well, there's really, if you think about the drivers of EM, there's many things that are in that supporting that market in the long term. First of all, when you think about long-term GDP growth, it's going to happen in emerging markets. They have the structural advantage. They have the demographics. It's really where the long-term drivers are going to be. So for us, we've always been interested in long-term opportunities there.
So is this all about, though, the growth story, economic growth story, or is this also more about central bank policy, at least if not turning dovish, at least not getting any more hawkish than where it is?
There's several things going on. There is definitely growth opportunities there. A lot of manufacturing doesn't occur in the U.S. I know we'd like to reshore things, but it still happens in a lot of emerging markets. Secondly, again, some emerging markets have actually been cutting rates and are much more supportive. And finally, it's just the valuation. You know, it's been a very attractive market. Now, you have to be careful. You have to pick your points, and you have to be active in your approach. It's not going to be everywhere.
Well, that's what I want to talk about. When we talk about EM, we can sometimes talk about it as if it's a monolith. But in this environment that we're in, is it just a broad EM allocation? Is it region by region, or is it country by country?
Well, so the biggest challenge with EM now is that China makes up north of 30% of emerging markets index. And there's just a lot of interesting and unique dynamics going on in China right now. So really, if you're going to do a trade in EM, we definitely recommend EMX China. However, even still, you need to be a little bit more nuanced because there are some markets that are benefiting, other markets that have been, flattish. So there's a lot of subtlety. I mean, we find EM in a great area for us, particularly for a quantitative approach, just because it allows us to be active and express our views across many different scenarios.
And it feels like EM ex China, when you're talking about EM, that is frequently the sort of asterisk that you hear on the end. But talk to us a little bit about China. At what point is it EM including China? What do you need to see there?
Well, China just has a number of headwinds that I'm sure we've heard about. Property, just kind of their focus. More I'd say a bit on state building than on capitalism. A little bit more involved individually in kind of individual companies. I think we really need to see some of those headwinds go away, particularly property market. It's probably moving in the right direction, but it's a very big challenge, and it's going to take some time to clear up.
I do want to circle back here to the U.S. and talk a little bit about some of the gains that we've seen over the last couple of months. And the complexion of those gains are a lot different than what we saw at the start of the year when everybody was just talking about those 7 to a dozen stocks that were really leading the charge. What's changed?
Well, it's very interesting because on one hand, you're still seeing it's still growth-driven market, but it's no longer as narrow as it used to be. Mm-hmm. So again, at the beginning of the year, it was all the AI craze, it was the Magnificent Seven, and really, since the market bottomed at the end of October, there's still some technology in there, but there's a lot of travel, there's a lot of kind of very consumer sentiment exposed stock, mm-hmm. Cruise lines, travel services. Mm-hmm. It's a much broader basket. Mm-hmm. In many ways, it's a much broader market. You see more than half of the stocks of the S&P 500 having positive returns over that period.
A lot of people talking about how this is a stock picker's market and this is a much more fundamental driven market. There's a lot of evidence, though, that a lot of the moves that we've seen over the last few weeks have been more technical than fundamental.
Listen, I think in the short term, technicals are going to dominate, but over the long term, fundamentals drive the long-term success of a business, which is going to drive the long-term performance of a stock. So we're believers, and it's important to get the fundamentals right. The technicals may time when you get in or out of something.
And let's talk a little bit about size here, because it feels like small caps have been unloved for the past couple months, maybe seeing a little bit of a resurgence right now. When you're evaluating different areas in the equity market, how are you thinking about large cap versus mid cap versus small cap?
Well, really, the equity party has been happening in the U.S. large cap. Nowhere else across the globe have we seen the spread between large and small, between growth and value like we've seen in the U.S. Now, arguably, some of the stocks in the U.S., there really is no equivalent globally, to some of the names out there like Tesla or Meta or Google. There really is no comparable name. So you almost can think about those as kind of unique companies. But longer term, there's definitely a lot of opportunities we see in small cap. A little bit on the value side. There's a lot of companies that have really not gone anywhere year to date, and still some very solid fundamentals.
George, always great to talk to you and great to have you here in person. George Patterson helping kick things off to the close here on this Tuesday afternoon, Chief Investment Officer at PGIM Quantitative Solutions. Coming up, a discussion here, a look forward, if you will, into 2024 as Wall Street strategists who largely missed this year's stock rally changing their tune. We're going to tell you what they're forecasting for the year ahead.
Plus, the IPO market may be ready to rebound with potential listings next year from companies like Reddit and Shein. We'll have the latest.
And a sit-down with Amazon Web Services CEO Adam Selipsky, live from the company's giant conference out there in Las Vegas. A lot coming up here on The Close. Stick with us. This is Bloomberg.
Well, we had a fresh slate of U.S. economic data and Fed speak out today. Stuart Paul of Bloomberg Economics joins us now to break it all down. And let's start with comments from Governor Chris Waller. He said he's increasingly confident that policy is currently well positioned to slow the economy, get inflation back to 2%. Does that seal the deal, basically, that December is going to be a pause?
I think so. I think the Feds definitely need to stay on pause through December. In fact, Waller was hinting that as economic activity slows, the Fed is in a position to begin cutting rates to begin its pivot in 2024. Looking specifically at the economic data, he did note that some of the most interest-sensitive spending items like autos are seeing some decline in demand and are seeing some deterioration in sales, suggesting that policy is getting at least to the point where it's sufficiently tight.
And we heard similar comments from Austin Goolsbee, who finally talked about this idea of seeing that disinflation trend outside of just food and energy. But then there was Michelle Bowman's comments, which I thought were interesting. And I don't know if she was just trying to hedge her bets or not, but the idea that maybe the Fed actually needs to do more, not just stay where they are, but actually needs to be even more aggressive in order to fight inflation.
Right. I think that part of what's going on with Bowman's comments isn't just a matter of hedging her bets, but just trying to strip some of the cuts that are currently priced in for 2024 out of the curve. By stripping out some of those anticipated cuts, policy effectively becomes a little bit tighter, and the Fed, perhaps counterintuitively, doesn't need to do as much work to continue cooling economic activity.
Well, of course, all of this depends on what we actually see in the data, particularly when it comes to inflation, particularly when it comes to supercore inflation, which I'm still trying to remember what that is. You actually over at Bloomberg.
It's super, though.
Supercore, I believe it's core minus housing, et cetera. I know that you're anticipating a slowdown in that supercore measure. What's actually going to drive that?
That's right. So it's supercore. We're focusing specifically on core services, excluding housing. It's the most labor-intensive spending categories out there. And what really matters most within the supercore is that when you have slowing wage growth, when you have a loosening labor market, you see that ripple through into the supercore first. So the fact that the supercore is going to be cooling from a pace of about 0.4% month over month to just about 0.1% in the October report out on Thursday suggests that the potential for a wage price spiral down the line, perhaps in late 24, early 2025, that probability is diminishing meaningfully. And again, that sets up the possibility of a pivot mid-2024.
Is the labor market, though, going to cooperate? Because Jay Powell keeps telling us that somehow this is not about inflation per se anymore. It's much more about labor market and how that feeds through to it. We've already seen some degree of softness. When does it get soft enough where they can finally sort of say we're done?
So there are really two phases to labor market cooling. The first phase is there's a slowdown in the pace of hiring, but people are still entering the labor force, so we're starting to see the unemployment rate tick up. That's basically what we saw through September. In October, we saw the first glimpses of that more material loosening that comes from layoffs.
Okay.
Sure, we saw payrolls increasing, but we also saw total employment within the household report declining. That's really what drove the October payroll report. And when that's the case, you see a more material jumps more likely in the unemployment rate, and you see a dramatic reduction in wage pressures, and that's what the Fed really wants to see.
All right, Stuart, always great to talk to you. Stuart Paul over at Bloomberg Economics, giving us the lay of the land, or at least how the Fed might actually see the lay of the land, and that's going to play a big factor into how folks view where the market goes next year. After getting blindsided by this year's equity rally, Wall Street strategists are going back to business as usual for 2024, predicting an annual gain. Bank of America, BMO Capital Markets, and Deutsche Bank, among those forecasting the S&P 500 will advance to new highs. Alex Semenova joining us right now to talk a little bit more about this. And Alex, let's get behind actually what they see in this rally, in a potential rally, extension of this rally beyond where we are right now. What exactly is driving that?
Yeah, Romain, so before we get to 2024, it's so important to talk about what happened this year because that is such a big part of the story. Obviously, going into 2023, most people thought that U.S. equities would go nowhere, that they would even post a loss, and that was an understandable call given the fact that everyone thought that rate hikes would tip the economy into recession, but instead everyone was blindsided by this incredible resilience in the economic data, a recovery in corporate earnings growth, this unprecedented artificial intelligence frenzy that has lifted tech shares. The culmination of all of those things has stocks on pace for double-digit returns this year. So it's really humbled those tasked with predicting the market's direction, none of whom saw any of this coming. And I keep asking people what everyone missed. And there are a lot of interesting answers. A lot of people weren't expecting a Fed pause this year, weren't expecting this economic resilience. But the two that stand out to me most is one, the market always recovers after a down year like the one that we saw last year. No ifs, ands, or buts. It's really that simple. And two, a lot of the traditional indicators indicators that everyone has been looking at haven't worked in this unconventional post-COVID cycle.
Yeah.
I will have to say, if you go back to some of the calls, they were right on the fundamentals.
Oh, yeah.
I mean, interest rates did rise, and it's just that stocks reacted in the opposite way. They actually rallied. So let's talk about 2024. We have the numbers in front of us. We know that we're expecting a gain here. What is some of the logic behind why we're going to see this rally continue?
Yeah, so strategists are finally caving to this bullish sentiment that we've seen. The fear was that after the first half of the year, when a lot of people failed to see it coming, they thought that perhaps that the rally wouldn't have much staying power into the second half of the year, that the impact of interest rates would catch up to the economy. But instead, we've continued to see the soft landing optimism and economic resilience, and that's going to continue into next year so far. A lot of people are getting on board with the idea that there aren't many potential headwinds at this point that can stop this run. BMO Capital Markets, Deutsche Bank, they were among the few firms to actually get it right, calling for an advance at the start of this year. And now they have some of the highest targets on Wall Street, 5,100 by the end of next year. They cite corporate earnings growth, continued labor market strength. And then Savita Subramanian at Bank of America, she's an interesting one because she was one of the first strategists mid this year to flip from bearish to bullish. Now she sees the index next year rising to 5,000. And what she says is that this isn't driven by optimism that the Fed will cut, but what the Fed has already accomplished, which is bringing inflation down and making companies more efficient. And she sees that continuing into next year.
All right, Alex, it's a great piece, great roundup. Our thanks to Bloomberg's Alex Semenova. And it's really interesting. If you read the story, too, there's a great quote here from Adam Parker, who used to be the Morgan Stanley chief U.S. equity strategist, basically saying that it's very fun to make fun of strategists.
Yeah.
But at the end of the day, I mean, they have a process, and, you know, they're just basically trying to read the tea leaves.
It is a process, and we'll always make fun of them. Anytime you stick out your neck and you're wrong, you're going to open yourself up to ridicule. But I thought it was interesting, and we've had a couple of these strategists on, and including, I remember Lori Calvasina has been very candid about some of the shifts that she's made in her forecast over the course of this year. And you get to this idea, what you just said, the underlying reasons as to why they thought the market was going to do what they do, that actually, most of those reasons actually proved to be true.
Yeah.
It just was the market reaction went in a different way. I also challenge people to go back and look at the effect of what she mentioned, Alex mentioned, the AI boom, and then now the Wegovy, Ozempic boom. And that's actually responsible for a lot of the gains that we saw this year. So if that hadn't happened, you sort of wonder whether some of the more dour sentiment on the street actually would have been proven right.
Yeah, it's a great question. Hopefully someone's watching who will crunch the numbers for us. But it's a great story.
We have 2,700 journalists and analysts.
I know, and they're all watching.
More than 140? No, they're none of them watching.
In any case, stay tuned, because coming up, we'll get a read on the IPO market as retailer Shein files confidentially for a U.S. listing, while Reddit tests the water for a 2024 public offering.
Are you on Reddit? I know you're on Twitter.
I actually am on Reddit. I'm on all the socials.
Okay, what's your handle on Reddit?
I'm not going to tell anyone.
Okay.
This is The Close on Bloomberg.
All right, as we get towards the end of the year, we have to take stock of just how weak IPO activity has been. But next year could actually see a pretty significant turnaround. Already we're learning from Bloomberg reporting that Reddit, Shein, Skims, drumming up interest in potential public listings. Katie Roof is covering this for us here at Bloomberg, and she joins us now for a little bit more on the story. And let's just start off here with the idea, with a broader appetite right now for new issues. And I'm just curious as to whether this is more about economic conditions, financial conditions, the Fed. What is going to provide enough appetite for people to come back into the market?
Sure. Well, they have to have confidence that institutional investors are going to want to buy their stock. The last 2 years, there hasn't been a lot of confidence in especially tech institutional investors being interested in buying new stock. There were a few IPOs in September that tested the markets: Instacart, Klaviyo, Arm. None of them went great, but there are so many companies that are at scale, and they've just been waiting for the optimal moment for a couple of years now, and we're hearing that quite a few are hoping to go in 2024.
And Katie, what's interesting to me is that it's kind of a motley crew of companies that we're talking about. I mean, Reddit, Skims, Rubrik, et cetera. These are all very different companies potentially eyeing the water here.
Absolutely. It's a mix of consumer, internet, software, fintech. We've reported Circle and Figure are also looking to go public. So it's definitely a mix. So we'll have to see. But yes, Reddit is looking to go as soon as Q1. But if you'll recall, they've been trying to go public for over a year. They tried to catch the last window when things were hot in 2021, but then the window closed on them. And so they are looking to go as soon as possible. They've been meeting with people helping them with their IPO prep again, sources tell us. And so that's one we're watching. Also, Shein, certainly a big one to watch. They just revealed that they filed confidentially for IPO. Sources tell us, and we expect that it could be valued around $90 billion when it goes public. And this was originally a Chinese company, but they have since moved their headquarters to Singapore, and it will be going public in the US.
I want to talk about Reddit just a little bit longer because I love Reddit. It's interesting to watch them just try to go public. Why do they want to be a public company so badly?
Well, they've been around for a while, and they have investors who want returns. They have employees who want their shares to be liquid and be able to, buy that house they've been looking for. And so there's always a lot of pressure on these companies. Usually there's an expectation that they go public within a decade or so. So Reddit has been around for a while, and they've been itching to go. At one point, we heard that they were comparing themselves to Snapchat and weren't thrilled about the multiples Snapchat was getting, but at a certain point, they just have to brave the markets and go through with it.
Yeah, it'll be interesting. Yeah, I'm not sure you want Snapchat's valuation, but it gets to the broader issue, too, about how the secondary market is going to receive this. I understand that the current owners in the private market want some sort of exit, some sort of liquidity here. But I was just going through the biggest IPOs of the year, Katie, and I'm sure you already know this. I mean, you have ARM and then Kava and maybe like Nextracker are really the only ones of significance that are actually in the green from their IPO price. I mean, that doesn't seem to bode well for the secondary market appetite.
Right. So you could say the enthusiasm is lukewarm at best. Maybe the window's ajar. Obviously, the window isn't, people aren't rushing to go public because the, investor enthusiasm isn't really there, but again, there's investor pressure on a lot of these companies to just go public as soon as they can. And so even though the conditions aren't ideal, they will try to go soon if they can.
Yeah. All right, Katie. And meanwhile, we're actually hearing more reports of companies looking to go private. Katie Roof, a busy person out there on the West Coast here, the IPO market potentially heating up as we get into 2024. A lot more coverage coming up here on The Close. Stick with us. This is Bloomberg. This is the countdown to the close, just about 2:30 here in New York. An eye on equity markets, which continue to tread water. A resumption of the Treasury rally, and believe it or not, crude oil now starting to perk up. Abigail Doolittle is standing by right now with a closer look at commodities with our Commodities Close.
Well, it seems that OPEC or traders are reassessing what the OPEC Plus meeting could bring, because after a number of days of declines, we do have oil trading higher, up 2.1% at a little above $76 per barrel for WTI crude. We also have gold higher for a third day in a row, up 1.4%, back above that 2000 level. Not so far from its all-time nominal high. Copper up 1%. Wheat is also up 2.2%. And I think that what these commodities all have in common, Romaine, of course, is the dollar falling for a fourth day in a row.
Yeah, great insight. Yeah, and you can see the dollar down there. Thanks to Abigail Doolittle there. A closer look here at some of the moves in the commodities space as we now pivot back to what has been one of the hottest stories of the last few months. That's the frenzy around weight loss drugs. While Ozempic has become a household name, it's actually not because the drug makers are fueling that fire. Rebecca Greenfield joining us right now to talk a little bit more about why. And I thought this was a great story, Rebecca. This idea here that of all the hype around these drugs here, this isn't really because of the marketing prowess of these companies.
Yeah, people really want these drugs. Originally, they were diabetes drugs that happened to cause weight loss, and even then, people were clamoring for them who didn't have diabetes, who wanted to lose weight. You know, they do cause dramatic weight loss compared to other things, and I think that is appealing to people who really want to lose weight.
So the fact that we really haven't seen television jingles, et cetera, I mean, there's so many drugs that we've seen advertised on television that say, talk to your doctor about if that's right for you. Clearly, these companies haven't had to do that, given it's a part of our national conversation.
Yeah, so there is some marketing from the companies. It hasn't been entirely grassroots, but a lot of it is also coming from word of mouth, also social media, also companies that aren't the drug companies themselves, like telehealth companies. In fact, there's so much demand for these drugs that they're often in and out of shortage. So the drug companies really can't even keep up with the demand, let alone trying to create more.
I am curious, though, about some of the regulatory issues here. I mean, as Katie kind of alluded to, I mean, when you have a actual real commercial, you know, they have to put those gigantic disclaimers down there. But, you know, if I go on TikTok or some comedian goes on stage and decides to, you know, tout whatever weight loss drugs that they're on, they obviously don't have that obligation. I'm wondering what kind of risk does that raise, or what type of liabilities, I should say, does that raise for the drug makers, if at all?
I don't know exactly what the drug maker liability is, but I do know that there's concern that these drugs are being touted for in irresponsible ways. So they're saying that people can lose an amount of weight that maybe they can't. They're being marketed towards people who maybe aren't the key demographic. Or like I said, these are really, some of them are for people with diabetes, and people who don't have diabetes are taking them, or even they're for people who are a certain level of obesity and it's not appealing to them. So I think it's yeah, they're not applying these rules that the FDA has set for certain reasons, and people say that's irresponsible.
All right, Rebecca, it's a great piece. Appreciate you walking us through it. Our thanks to Bloomberg's Rebecca Greenfeld. And it's a really interesting story here, Romaine. Again, the fact that they don't have to advertise, and even with them not really putting as much muscle behind these drugs, they're still dealing with supply shortages. Yeah,
it'll be interesting. I mean, at some point, obviously, this will shift, and they're going to have to actually pull out the ad dollars in order to get people, or at least get the right people onto these things here. But it also just shows you now, I mean, just the power of social media, and just what do you call it, like that kind of sort of organic virality that you can have right now, and you can't buy that. There's no, you know, I don't care how many, McKinsey consultants and marketing people you put into a room, they can't replicate that. Yeah, that word of mouth, sort of grassroots movement. It's going to be interesting to see what happens when they actually do start advertising, what that translates into. But I think also becoming a household name, Ozempic, like people just associate that with that's the weight loss drug, but that's a diabetes drug. There are weight loss drugs out there, but that nuance is sort of lost in public conversation. Yeah, absolutely. Well, we go from weight loss drugs to Foot Locker, because still ahead, what to expect from Foot Locker as analysts flag its ability to shake off excess inventory risks and weak comp sales. We'll preview the results next. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Boeing, an upgrade to outperform over at RBC. This amid a significant shift in investor sentiment after months of supply chain disruptions and lowered guidance at the airplane maker. The analyst now says that the setup into next year, favorable, strong demand for both Boeing's commercial and defense businesses. Those shares having a pretty strong day, up 1.5%. Next up, let's take a look at a firm raised to hold over at Jefferies, which cites stabilizing credit conditions and inflationary pressures that have actually spurred greater use of buy now, pay later services. The price target goes up from the second lowest on the street at $9.50 a share to the second highest on the street at $30 a share. Catching up here, up 10% on the day. And finally, Crocs, climbing to the top, going from outperform to strong buy. This over at Raymond James, with the analysts there saying that the low bar for estimates and valuations point towards an attractive 2024 setup. They also see product innovation, expansion in Asia, brand heat driving revenue growth. And the analyst didn't stop there. He said they put the footwear company on its favorite list, replacing Lululemon. Those shares up about 5% on the day, and those are some of our top calls. Let's stay in the apparel space and, well, even the footwear space, and talk a little bit more about Foot Locker. They're scheduled to report results tomorrow before the bell. And while some retailers are forging ahead despite macro pressure, some say Foot Locker, they've missed a step. Janine Stichter joining us right now, consumer retail analyst over at BTIG. She lowered her buy rating to neutral. And Janine, let's start off here with the relevance of the Foot Locker brand, which I know has been waning, but I'm wondering what's left there that could actually maybe turn this around.
Yeah, I think there's still a lot of recognition left in the Foot Locker brand, and that's why we do think this is ultimately fixable. Our downgrade to neutral was based on the fact that we think this takes a lot longer than expected, just kind of given the macro environment that we're in and the fact that their customer base skews really heavily towards a lower income consumer. It's about 50% lower income consumers, and they're selling a really discretionary category. And at the same time, we do think the Foot Locker brand has a lot of recognition and carries a lot of weight. The competitive landscape is not the same as it was. You have brands going direct. We've heard a lot about that from Nike, but also from others, even like a Hoka or an On, brands that are trying to go more through their own websites. And then we also have companies like Dick's Sporting Goods putting a lot of investment behind Foot Locker.
Well, that's what I am.
JD Sports, which hasn't done much in the U.S. until recently, and Hibbett. So all of those together make it a much more competitive backdrop than we've seen in the past.
Well, that's what I'm curious about. I mean, people of a certain age remember that, Foot Locker was the place you had to go if you wanted to get, whatever the latest sneakers are. Now, as you said, I can go directly to Nike or maybe some of the bigger retailers and get pretty much the same products. Are there things on their shelves right now that are either exclusive to them or at least semi-exclusive to them that I would have a reason to go straight to Foot Locker rather than to go anywhere else?
There are, but I'd say typically where we saw them have the most exclusives and really why people shopped at Foot Locker was the relationship with Nike. What we've seen over the last couple of years is the relationship with Nike has waned. They're looking to rebuild that, but they have less exclusives than they once had. And there's other places where you can get Nike product, perhaps with more exclusives, like a Hibbett, like a JD, like a Dick's, than we had in the past. So I think that whereas that they were kind of the destination for exclusives from Nike, there's now other places where you can get that. I think what we'll see from them as they try to go about this turnaround is more exclusives in the basketball category, which is really their bread and butter and what they're known for. And I think there's a lot of opportunity there as they kind of focus squarely on the one category that they're best known for. But we're not going to see a lot of that in Q4. We're seeing the early innings. They just launched a partnership with the NBA. It's a marketing partnership. But that's something we'll see more into next year where they really try to focus in on that category.
So opportunity in basketball, but let's talk a little bit more about the Nike problem because, the numbers vary, but north of 60% of Foot Locker's sales come from Nike products. What can CEO Mary Dillon say tomorrow that would soothe fears here?
I think it's really more about how they can kind of manage through the near-term transition of going from, as you mentioned, historically they were over 70% Nike. Last year, I think it was around 65%. Now they're working down towards 55 to 60% Nike. So they're still kind of managing through this transition. And what she can say that will help people understand that there's a path here is that they're growing with other brands. So brands like On, brands like Hoka, which are very hot in the market right now, even brands like UGG that we saw them highlight front of shop for Black Friday. Understanding that they're getting better allocations and expansion of those products that typically they didn't sell as much of, I think can help investors understand they can manage through this transition. But it's an uphill battle because, as we mentioned, those brands are selling through their own sites. They're selling through a lot of other retailers. And I think for Foot Locker to become known as the destination for those brands, the same way that they've been known as a destination for Nike, is a bit challenging right now.
I will say it has been surprising to watch Uggs become cool again. I wasn't expecting that one, Janine, but let's situate this conversation in the economy right now, the economic backdrop, because we know that interest rates are very high, inflation is still high, and of course there's a lot of risks out there. And when you think about Foot Locker's customer base, if we do see an economic downturn in the next year or so, how would Foot Locker fare?
Yeah, I think this is where we see the most risk at Foot Locker versus some of their footwear peers. As I mentioned, they're about 50% lower income consumers. And when you kind of broaden it out to the middle to lower income consumer, it's probably 70 to 80% of their base. So this isn't an affluent customer base versus, say, a Dick's, where their customer skews towards middle to upper income consumers. I think their customer is more sensitive. It is more likely to pull back on discretionary purchases as we go through an economic downturn. We did some work around this specifically, too, as it relates to student loan repayments, which just resumed in September and October. And there's outsized exposure there because of the customer base that they cater to. They also have a younger customer base. And I think that they could see a headwind that's bigger than the broader footwear industry based on some of the survey work that we did in the fall.
All right, Janine, great stuff. Great to talk to you. Janine Stichter over at BTIG. A closer look at Foot Locker. Shares higher on this Tuesday afternoon as we expect their earnings tomorrow, Wednesday, before the bell. I don't know, Katie. I remember when I was a kid. I mean, Foot Locker was kind of the only game in town. If you wanted like the really cool sneakers and you don't want to wear like the stuff that your dad or your uncles were wearing, and that was where you go. You wanted the new Air Jordans, all that. But now it's like there's just so many options out there. Not to mention, obviously, just going directly to Nike. She even mentioned you're a Hoka person.
Am.
Is it Hoka or Hoka?
It's Hoka.
Okay, Hoka.
Hoka One, actually. It's not Hoka 1-1.
Okay, you'll have to explain that to me.
I will.
Now,
we'll talk about it.
I learned something every day on this program from you. So where's that from?
I don't actually know.
Yeah, okay.
I just know that I love the shoes. They're like moon shoes. You know, you feel like you're walking on air. It's great.
You know, I was in a store the other day, a department store, and I didn't know. Do you know what's making a comeback? Moon boots.
No.
Yeah, they had a whole display of them in the Nordstrom here in New York. I mean, you mentioned Uggs coming back. I mean, moon boots are even uglier than Uggs.
You know,
and even uglier than Hokas.
If they made me faster, I would wear them, but I don't think moon boots are necessarily going to get me that PR. But in any case.
Well, it'll get you a lot of attention, that's for sure. All right, coming up here, a focus on the dollar and dollarization. That's a big question right now for Argentina and its new president. We're going to ask Ishwar Prasad over at Cornell exactly how the dollar would play in the Milei's economic reform. That's coming up on our Wall Street Week Daily segment after the break on The Close. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, as you know, there was a big election in Argentina with a very colorful figure who is now leading that country. And he has some very colorful plans for their economy, including getting rid of Argentina's currency and actually going to a dollarized economy.
Yeah, no more peso if Dr. Milei has his way. He's in actually U.S. this week before he gets inaugurated. But the question is, what does dollarization of Argentina really accomplish, and can it be done? To answer some of those questions, welcome now Ishwar Prasad. He's Senior Professor of Trade Policy at Cornell University and a Senior Fellow at Brookings Institution. He is also, importantly, the author of The Future of Money. So, Dr. Prasad, thank you so much for being back with us. So let's start with the most basic thing. This wasn't a popular idea, evidently, in the election in Argentina. If they could do dollarization, what would it accomplish?
So the objective of dollarization seems to be, as President Milei has put it, to try to get rid of a currency that he has characterized as worthless, and he's used even stronger language. Now, the reality is that the Argentinian peso has not been doing well because of government policies that have been quite spendthrift. There have been very large levels of external debt, domestic debt, and so on. And dollarization is seen as a way of restoring confidence in the country to some extent by getting rid of a currency that is sort of seen as symptomatic of the country's problems. I don't think it's going to essentially solve anything. It will certainly put some constraints on the Argentinian central bank's ability to print money in order to finance government deficits. So it will certainly lock in monetary policy in place. It will reduce inflation, but will it really solve the fundamental problems of the Argentinian economy, which is really about a government that is not doing its job of managing the public finances? Not quite. There is also the question of whether it is feasible, because in order to conduct dollarization, you need to have enough dollars in the first place so you can convert your existing monetary base into that currency. And right now, Argentina is very, very short of dollars. I'm not quite sure it can even make the transition if it wanted to.
So Ishwar, I'm curious about the central bank. You referred to the central bank. If that's part of the weakness of it, he has a plan for that as well, which is basically to eliminate the central bank, not have it there at all. If, in fact, he did that, he went to dollars instead of pesos, and he eliminated the central bank, how would that play out? What would they do to the banking system? What would they do to individuals living in Argentina?
So there is a transitional issue, David, and then the longer-term issue. The transitional issue is that given that the Argentinian economy is de facto dollarized, you might think that there isn't really a problem in terms of switching to a de jure dollar regime as well, because after all, most people in Argentina are using dollars. But the reality is that pesos still do play a very important role in the Argentinian economy, especially in the Argentinian financial system. So if all of a sudden you were to try to replace pesos with dollars, that could have pretty serious consequences for the banking system if it does not have access to dollars that it needs to manage its commitments. Then there is a longer-term issue about whether tying Argentina's monetary policy to U.S. monetary policy, which would in effect be what Argentina is doing if it adopts the dollar as a national currency, is good for Argentina in the long run. Certainly, it would reduce the probability of the central bank being able to print money to finance government deficits. That would certainly bring inflation down, but it would mean that in the future, Argentina is constricted in terms of being able to use monetary policy, including the exchange rate, in order to buffer itself against various shocks that might hit the economy. So it will put a straitjacket in the economy, and this could end actually disastrously if you do move to a dollarized regime and the government tries to continue with its fiscal excesses, if it doesn't rein in its spending, if it tries to get around its domestic and external debt burdens through default, that could actually lead to money fleeing from the economy. So you might have low inflation, but an economy and financial system that are collapsing.
Yeah. Well, that's what I'm curious about. I mean, because this really isn't theory anymore. I mean, we have several countries that have currently doing this, others that have tried and abandoned it. And when we just had on the screen, Professor, some of the other countries that I guess represent some of the worst performing currencies, and it had Lebanon on there. And I was thinking about their move to kind of do that incremental dollarization where effectively you start in certain industries and then try to roll it out. And I know, at least based on our reporting, that's pretty much been a disaster so far this year. And I'm wondering, is there any roadmap at all that Milei could have where he could actually successfully pull this off?
So one question is whether if Argentina was willing to undertake all the policies that it needs to undertake in order to for dollarization to succeed, whether it would still need dollarization. Because if you do all the right things, you could have dollarization work. You could bring down inflation. You could also undertake a broader set of, fiscal and as well as other types of structural reforms, including the reforms to the health, education, and pension systems, which Argentina really needs. But if you can do all of that, then the question is, do you need dollarization? But the difficulty, of course, right now is that those reforms are politically very difficult. Mm-hmm. I mean, Milei has been elected as president with a thumping majority, but he doesn't have much control of Congress, which has to pass many of these legislative actions that he is proposing. So perhaps his end game here really is to talk about dollarization as something that he would be willing to inflict on the Argentinian economy and perhaps use it as a bargaining chip in order to push Argentina towards all the reforms it really needs. It's a very dangerous strategy, but at one level, given where Argentina is right now in terms of the political status, maybe it's the only card he really has left to play.
But does the size of the Argentine economy actually work against him in this case? I mean, I was just trying to go down the list of countries that have gone through this, and I really couldn't find one that actually had the same level of economy that would require, effectively, as you mentioned earlier, a huge purchase of dollars that I'm just not sure they're going to be able to do.
That's going to be very difficult. And you're absolutely right, Romain, that there are smaller economies that have either de facto or de jure dollarized. There are many in the Latin American region as well, at least a couple, including Ecuador. So this is at one level a desperate measure by a desperate government to try to revive an ailing economy and bring down inflation. But for an economy the size of Argentina to attempt this would certainly be an enormous challenge. And right now, the difficulty is that the Argentinian central bank does not have any dollars to play with, either to pay off its external debts or to facilitate a shift towards dollarization. The official gross foreign exchange reserves are somewhere in the range of $30 to $40 billion, but the net reserves, there is a dollars that Argentina actually has to be able to conduct this transaction are seen to be somewhat negative because of all the commitments the central bank and the government have made more broadly. So even the transition is going to be very difficult, and you're absolutely right. To get enough dollars for the currency to become the de facto and de jure currency of the entire Argentinian economy, that's going to be a very difficult challenge.
Professor, thank you so much for being with us. Really appreciate this. Ishwar Prasad of Cornell. He is the author of The Future of Money. And some of those external debts are owed to the IMF.
Yes.
And one of the things I read is they've had 22 IMF bailouts in 65 years. That's one every 3 years.
Yes.
The IMF's good. So I wonder what the IMF would think about all this.
I'm sure they're going to have a big say in this as they move down that road. That doubt, it seems like Milei doesn't really care. He pretty much has his own agenda. And of course, I don't want to make too much light of this, but we should point out, too, that there are a lot of dollars floating around the Argentine economy right now. Just not not officially.
Well, something like over $200 billion
Yes.
are in people's mattresses and things like that, as I understand it. So, so they can get some access to dollars somehow. And you're right, you should make light of it. There are people really suffering because of this down there. And then on Friday, we're going to continue the emerging markets conversation with Joseph Sitt. He's founder and chairman of Thor Equities, and that's going to come out at 6 p.m. New York time, Romaine.
All right, and of course, David Weston joins us every day around this time for our Wall Street Week Daily segment as we round off into the final hour of trading here on this Tuesday afternoon. U.S. equity markets treading water right now, but most of the action is in the Treasury space. A resumption of that monster rally as a lot of folks really are betting that the peak in rates has already come and gone. We'll be back in a moment. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostic.
And I'm Katie Greifeld.
Somewhat tepid price action, to say the least, here in U.S. equity markets. Not sure what folks are waiting on. Maybe it's just the lack of, I guess, any real catalyst. But nevertheless, we're kind of treading water on equities with most of the major indices right now relatively unchanged. But one interesting thing that I thought that really could have caught my eye was the move that we continue to see in gold. That's the second line on your screen there. Spot gold right now at 2,041. I believe the high is around 2,060, 2,070.
Yeah, and it's interesting to see gold gain some traction here. We know that the dollar has been on a bit of a rough run, but you take a look at the equity market. I'll note that volume way lower for at least a second day in a row. It was pretty low last week as well. In terms of what the catalyst will be, we do have a Fed meeting coming up, but that's still 2 weeks away.
Yeah, well, flip up the board here because I was actually taking a look at some of the bets in the market, on the options market right now, for rate cuts, and you can see here, without even looking at the numbers, the amount of rate cuts being priced into this market have really surged. Most people now, they're really not buying the Fed, and they're sort of a stare down that they're going to remain where they are. Most people think they're going to have to cut, and they're going to have to cut soon.
And I think it's really telling, too. I mean, we've been in this period for so long where every piece of Fed speak, it feels like, would move the market in any such way. Now we're getting Fed speak and the market's not moving.
Yeah.
So clearly it feels like investors have decided that what the Fed is going to do, at least by their reading. But let's talk about some of the individual movers, because under the hood of a pretty boring index, you do have a lot of equity movers. Let's start with Micron. This is an interesting story. It came out with updated guidance. It increased its revenue outlook. It narrowed its loss per share guidance. That's all good news, but the memory chip maker also said that adjusted operating expenses will come in at $990 million in the fiscal first quarter. Analysts, the previous forecast rather, had been for around $900 million. So you can see that disappointment working its way through the shares. But let's move right along here, because I want to talk about Tesla.
Oh, sure.
Tesla, the
we don't talk about
the Cybertruck launch. It's coming on Thursday after years of delays. The stock is up 4% today. The sell side has been talking about this. You had Wedbush saying that it's not going to affect the finances for 2024, but Deutsche Bank did say. Will
it affect the finances ever?
I mean,
why are we dancing around this? Yeah. I mean, this thing is ugly. I know there are certain people out there, including some that might be on the set, somehow think this is cool. You're going to buy one of these things? Just admit it.
I'm
just
not
admit it live
buy
on
one.
air.
Am I going to maybe tweet a picture of it and say I want this so bad? Maybe.
And hope that like your husband buys it for you for Christmas and puts a nice little bow around it, like in those commercials.
Send out some signals into the universe. Deutsche Bank saying it's creating a halo effect of sorts. People are going to the Tesla showrooms, etc. Do you want to talk about it?
They're going to the Tesla showrooms to buy or just to gawk?
They want to see it, but again, it's
they want to see how
this
ugly it is.
Halo effect. They're looking at other Tesla products as well.
And the thing's gigantic. I mean, I know all our trucks, the tradition here in the U.S. is that if we can build it bigger, we might build it better. I think we're out of time, Katie Greifeld. Did you have another stock?
Firm is up.
Stick with us. We're counting you down to the close.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld, joined now by our colleagues Carol Masser and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms, television, radio originals, and our partnership. For those folks, Carol Masser,
hello,
who for some reason or streaming us on YouTube?
Because we're really good.
I heard they're a
four
big
of
partner
us.
of ours.
Yeah.
I hear you're on YouTube.
Yeah.
You're like there the whole time.
Yeah, I'm a big YouTuber, me and the cats. Having said that...
That's what Katie watches on YouTube.
Pretty much. Carol and cats.
Why not?
Are these cats giving financial advice? What is it?
In some cases.
Everybody seems to be at this point. It feels like we're getting so many different things, which is why when we get some economic data points, I feel like it's really smart. In a week where we're also going to hear from, and already are, a lot of Fed speakers, but home prices hitting a record high.
No.
Yeah.
Really?
Fresh record high, up 8 months in a row. Wow. You know what's going on, right? There's not a lot of supply out there. People aren't moving out of their homes because they like their low mortgage rates that they've got, and people aren't building new homes. So it's that supply, when there is a home that's available, a lot of times you're seeing bidding wars. Detroit, San Diego, New York among the cities with the biggest price gains. And then we also had some other data on consumer sentiment.
Yeah, consumer confidence rising for the first time in 4 months in November. Perhaps Americans are getting more confident with what they're seeing out there, Romaine. It kind of bodes well for the holiday shopping season. It also kind of plays into the data that we got from Adobe for Black Friday, for Cyber Monday, and then Amazon reporting record sales on Monday and Friday as well.
So is this the idea that people are actually feeling better? I thought there was a great column by Betsy Stevenson on the Bloomberg Opinion, economist over at University of Michigan. She kind of talked about this idea that what the data is showing and what people are saying are two different things. Basically, everyone's angry at how bad the economy is, but when you actually look at the data, they continue to spend and they continue to spend.
In that consumer sentiment number, the metric of expected inflation, I think that eased, as well as more consumers are thinking that we're going to see lower rates next year. So those are big things that will make you feel more confident about to go out there maybe and do some purchasing.
Or maybe they're just confident because their home prices continue to go up and up and they feel like they have a lot of equity in their homes so they can spend money.
Mm-hmm. Yeah, there's a lot of interesting dynamics at play. I want to go back to markets though, and I want to introduce some lighter fare. I think you guys know that I like ETFs a lot. I cover the ETF.
Do you host a show about ETFs
too?
I do.
I host a show about ETFs Mondays, 1 p.m. Eastern.
Katie ETF Greifeld?
I don't know about that one, but there was an interesting thing that happened last week. Actually, this news broke on Thanksgiving, but there actually was a meme ETF. I don't know if you guys remember meme stocks. About 2 years ago, they were all the rage. There was an ETF, the Roundhill Meme ETF, that launched to try to basically ride the rise of the retail trader. That ETF is now shutting down. It will liquidate nearly 2 years after it originally launched. You can see the performance there. If you are streaming on YouTube or watching on television, it badly lagged the S&P 500 in the time that it has existed. It was only able to attract about $2.6 million in 2 years. So it just wasn't able to capture that lightning that we saw among the day trader crowd.
Well, I mean, we tried to capture lightning for what effectively, at least for a lot of those stocks, were kind of fad stocks that probably weren't going to stick around. So I would assume that had to have played into it, right?
Exactly. I mean, it did screen based on social media sentiment, et cetera. It did rebalance more frequently than other ETFs might have. But in trying to package this into a portfolio, I mean, this was already hit or miss. And then you end up with...
Is there a reverse ETF for the Cybertruck that I can take a look at?
It's coming. Now that you've spoken it, it'll be...
Katie was just telling me before we got to you guys that she's actually interested in buying the Cybertruck.
I think it's so ugly, it's cool looking. Come on.
Yeah, she's going to do that wearing her Uggs and moon boots or whatever.
It's a heavy car, right? All that steel.
Yeah, it's super big.
It's like something out of Mad Max.
Yeah.
I could see you driving that thing across the GW Bridge, Katie.
Can it pull a horse trailer? Is that why?
I think it probably could.
I think you can fit the horse in the truck, actually.
Really? You couldn't even fit a bicycle in there.
Yeah, they have it has a really small trunk. That's the problem.
Listen,
or whatever it's called.
I'll report back.
Well, all I'm going to say about the ETF story, Vildana Heinrich did an interesting story earlier this year and just talked about the pace of ETF closures. We're like double the rate of last year when we saw just an explosion in ETFs. And so a lot more competition, a lot of consolidation that we're seeing in that area.
Record launches and closures this year, actually.
Don't you feel like, though, it's like people just have an idea and they create an ETF? And I just think it's got to be, to some extent, fundamentally based. Yeah, I don't know. Should we go back to the Cybertruck?
That's all I'm thinking about.
All right. No. Anyway, I guess that's it, right?
Yeah. I mean, it is. You're not really good at goodbyes, Carol.
I'm not. Big family.
Are you like one of those people when you're leaving a party, you're like saying goodbye for an hour and a half?
My husband's like, start saying goodbye
now.
Your
husband's like pulling you out
Exactly, honey. Let's go. All right, guys. We will go. I am going to wrap our cross-platform coverage, radio, TV, YouTube, and Bloomberg Original. See, I can do it. We'll be back in less than an hour's time for Beyond the Bell, 4 p.m. Wall Street time.
And we continue our coverage right here on Bloomberg Television, counting you down to the close. We just got about 50 minutes until we get there. And yeah, we can talk about equities, we can talk about treasuries, but how about gold? Right now it's sitting at the highest level in about 6 months. And quite frankly, just a whisper away from the recent highs that it had, I think, back in 2020. Our next guest actually sees gold as an attractive opportunity for investors. Michael Cugino joining us right now, president and portfolio manager over at Permanent Portfolio Family of Funds. Mike, great to have you here on the program. Give us a sense. I mean, what actually is the thesis behind it? Is it that the Fed's out of the way and now gold can kind of do its thing that most investors expect it to do?
Hey, good afternoon, Romaine. Thanks for having me. That's one of several factors, I think, and I'll try to list them or some of them. First off, I think the dollar is going to continue to come off the highs it experienced in the last couple of years, and actually more broadly from the last decade or so. It reminds me a lot of the 1990s when you had a strong dollar and gold languished, only to catch up in the ensuing decade and a half after that. The dollar we expect to revert to the mean, and I think that would be one factor. It's been unusually high vis-a-vis other currencies. The second would be the Fed, like you said, close to being done, if not done already, and possibly cutting, if you believe some of the news today. That means that real rates of return could be lower or smaller or even negative, depending on how rates go. That's generally bullish for gold. Central bank buying around the world remains strong, especially among some of the countries that are looking to, if not displace the dollar, then at least create an alternative payment scheme around the world using, gold as a backing for some sort of transfers of payments. For trade and other things. We've seen it with the Ukraine-Russian thing, and the oil that's trading, the Russian oil trading around the world. Geopolitical risk is still out there, and that's a factor as a threat to the financial system. And then lastly, the fact that gold has held up incredibly well despite volatile rising rates the last year and a half. You would have expected to see something like a complete fallout in the price, usually. And I would go back to 2013 and the taper tantrum and all that to look at how far gold fell during that rate increase. And gold held its own very well over the last couple of years. So we wouldn't advocate overweighting it, but we think that most portfolios could use some of it like we do as an anchor in a broader diversified strategy.
And I'm sure you know that over the last few years, a lot of people sort of strayed away from gold, at least as a physical hedge that it would traditionally play in the portfolios. Maybe that's because, A, they either didn't feel they needed to hedge or they were able to find other sort of non-physical assets to hedge against. Do you worry at all that some of those trends that had led us to where we are today, meaning non-physical assets, whether they're talking about crypto or some other things, might actually be competing for gold's attention?
Well, gold doesn't pay interest or dividends. It's capital appreciation. It's a hedge against inflation and declining unit value of currency. So that is an issue, especially when you can get higher yields in other places or just plain growth. You're right that people didn't feel like they needed to hedge over the last 10 to 15 years. Equities were going strong. The dollar was strong. Interest rates were low. Geopolitically, it was kind of a calm period. So who needs to hedge with gold, right? But this is a very different world and a very different set of circumstances, and investors need to keep that in mind. So that would be part of the thesis as well in terms of where we are right now. Those factors are always at play, and so that's why you want to use it as part of portfolio planning. But unless you're a real true speculator or trader, you're probably not going to trade in and out of it based on short-term factors. We would basically say with gold, you figure out how much you need to be properly diversified in your eyes. You wait for periods where it's reasonably priced, and over the next 3, 5, 10 years or so, you would expect it to be higher.
So a place for gold in the portfolio. Let's talk about the rest of the portfolio. You mentioned, of course, if the Fed cuts rates, then the real return on bonds will be lower. But how are you thinking about fixed income at this juncture?
We think there's still a lot of uncertainty. Clearly, rates have come down quite a bit lately. And I think everybody's trying to step over each other, figuring out when to lengthen duration. A lot of firms have already done it. Some are considering it. And then at how long do you go, right? We've taken the opposite stance, I think, from that conventional wisdom at the moment. We're relatively short, 3 years in. We're taking advantage of the real high rates, mainly because we see more volatility that maybe hasn't been fully reflected, either in economic activity or just interest rate volatility, supply, demand, the size of the U.S. debt, global considerations, et cetera. So, like everybody else that manages bonds, we're sensitive to lengthening duration, and we'll do so gradually or opportunistically. But we're also looking to take advantage of shorter-term rates right now, which are still relatively high.
All right, Michael, that's a good place to leave it. Really appreciate your time. That is Michael Cugino. He is president and portfolio manager over at Permanent Portfolio Family of Funds. Now coming up, we'll talk with Amazon Web Services CEO Adam Selipsky, live from the company's big conference over in Las Vegas.
And we're expecting a slew of earnings after the bell tonight from a wide variety of software companies, including Hewlett-Packard Enterprise, CrowdStrike, Splunk, and Workday. Results first here on Bloomberg.
And Goldman Sachs fighting for AI talent as it loses more than 100 staffers to its rivals. We'll dive into the fierce AI competition among Wall Street's biggest banks. All that and more coming up. This is The Close on Bloomberg.
The price action once again in U.S. equity markets, somewhat subdued, volume somewhat low, though some individual stories out there that you should pay attention to. We were just talking about Micron moving lower here on the day after that company updated its forecast, a downgrade for Morgan Stanley, and some big concerns heading into earnings tonight out of Hewlett-Packard, Workday, NetApp, among a few other names in the software space. One of the bright spots on the day, you'll find that in biotech, SpringWorks Therapeutics up about 20% on the back of FDA approval for its main oral tumor medication. Now, the price action in the equity space might not be much to speak of, but it certainly is in the Treasury space. Most of that activity right now on the short end of the curve, 13 to 14 basis points lower right now on a 2-year yield. The price action, the resumption of that rally now back in full. Abigail Doolittle is joining us right now for our Options Insight segment. And Abigail, you are taking a look indeed at U.S. Treasuries and the volatility that we continue to see there.
It's hard not to notice it, Romaine, with that move that you were just talking about for the 2-year yield on the day, down 13 basis points. I think over the last 2 days, down closer to 20 basis points. And this, of course, within the big backup over the last few years, close to the same amount of the 2-year yield. In other words, the backup has been almost, let's call it 4.75%. So much volatility. Talk more about it and what it means for other asset classes. Pleased to bring in Spencer Heikemian, the investment officer at Tulu Capital. Great to have you with us. And what do you make of this bond volatility? So many people have been talking about it, and the idea that stocks are right or bonds are right. Only one of them can be right. But one thing we know is that we have this tremendous moves in treasuries and yields, and it seems as though everybody's waiting for the Fed to fix some sort of price. Investors seem to think that they are on hold. But what do you think? We, of course, have PCE later this week and Fed Chair Jay Powell on Friday.
Well, thank you for having me, Abigail. And, when you look at the wider context of financial history, this type of volatility, especially late cycle, is actually not so unusual. Obviously, it is unusual in the post-2008 world of QE, of zero interest rate policy, of debt monetization to an extent. But, when we see the 10-year go from 5 at the beginning of the month to 4.34 today, that does seem unusual. But when you consider how much that the bond market is attempting to discount in, whether it be a hard landing or a soft landing, no landing, a resurgence in inflation, possibly even an undershoot of the Fed's 2% inflation target in some scenarios, this is really healthy. This is price discovery. This is the essence of what capital markets are designed to do. So as we get new information, like you said, the PCE later this week, auctions that are happening on a weekly basis, we are going to experience some volatility in the Treasury market. And this may seem unusual to us, but this is a reversion to the mean, I would say.
You think so? Okay. Well, it is, you make a great point, and you actually reminded me of something from years ago. You're talking about the late stage cycle, because of course it's a stock market cycle followed by a business cycle followed by an interest rate cycle. So if we are at the end of that cycle, I guess the big question is what's next. Let's bring the employment picture into that, because one thing that is definitely keeping the Fed, I would think, on hold to some degree is this relatively hot, very super stable job market.
Right. So one of the most interesting pieces of research that we've come across recently has been the non-linearity in the rise in the unemployment rate in every business cycle since World War II. And what the research found was that in every cycle, the unemployment rate either rose by less than 50 basis points or at the minimum by 200 basis points. Now that's pretty relevant to remember now because we had a cycle low in the unemployment rate of 3.4%, and right now we're at 3.9%, which essentially means we are at that 50 basis point threshold, which would mean that based on history, there's a reasonable probability that we could have up to a 5.4% or higher unemployment rate at some point during this business cycle. And how many shops on Wall Street are discounting in a picture like that?
And I think our own Bloomberg News' own Anna Wong did some work around that. So that's really interesting. Then thanks for bringing it to our attention. The question, I guess, will be, is a potentially above 5% unemployment rate, is that bad news as in bad news, or will that be bad news in terms of good news? Talk to us about diversifying among asset classes with all this volatility.
So with this wide band of potential outcomes that we could experience in 2024, we think the most pertinent thing that you could do is to be balanced across the asset classes, whether that be through balancing your equities and your treasuries with your gold and your oil and your FX. And essentially, when you balance all these asset classes that are comparable in their risk-adjusted returns, you are going to still maintain a similar return profile, but with significantly lower risk. And we think that's very important heading into a year that's quite uncertain with what could happen in the economy and in asset markets more broadly.
Diversification does sound like a pretty good idea amid all of this uncertainty that we've had and may have in the future. Spencer Haikimian of Tulu Capital, thank you so much for joining us today for Options Insight. And from New York, this is Bloomberg.
Well, Wall Street's battle for AI talent is coming to a head after months of heavy recruiting from the big banks to fill their ranks. Fortunately for Goldman Sachs, it's been on the losing end of that fight. It's lost about 60 people to rivals, including Morgan Stanley and Citi. And of course, Romaine, those are small numbers in the context of the thousands of people that are employed by these banks. But it's interesting to see this sort of arms race going on.
Yeah, I love these types of arms race types of stories here, too. And I mean, we're picking on Goldman Sachs. We should point out, I mean, Bank of America is kind of in the same position. I think they had a net loss of about 55. And I feel like it's even worse. They said they lost like something like 179 people to other firms, though they did hire away 124. So they're really on a net basis just kind of right behind Goldman Sachs here. But who do you think the winner is?
I actually know who the winner is.
Who is it?
It's Wells Fargo.
I know. I was surprised. I was like, Wells Fargo?
I know.
Are they really trying to like just become the hip kid on the block
Maybe
now?
they have big ambitions because according to this story, which of course looks at data from consultancy Evident, they've seen the biggest net increase with 130 people in the past 12 months or so.
Yeah, I was surprised by that. And JP Morgan's up there too, which doesn't surprise me. But interesting to see. And I think too, it's interesting too. I mean, obviously we don't know what these jobs specifically are for, but I would assume that some of these are probably going to be for some of the more consumer-facing products. So it kind of makes sense that the banks that have a much more of a larger consumer banking business will probably be much more going after these types of folks.
Let's talk about what they're getting paid, because of course that's also
you're going to make me cry.
A very interesting detail in this article. Median compensation, this includes any annualized equity grants, $900,000 last year.
Yeah, and it's not just the experienced people too. I have a kind of a friend of the family who recently got hired, young guy. And I won't say what he's making, but it's well into the six figures. I mean, when I started my first job in my 20s, I literally got paid in like bubble gum and popcorn.
That's pretty hopes and
this
dreams.
guy's about to retire and you know.
Amazing. Yeah, well, keep an eye on Wells Fargo. This is The Close on Bloomberg.
This is the countdown to the close. Just about 30 minutes until we get to those closing bells. Katie Greifeld, and the price action today, I don't know. What do you make of it?
It's another quiet day in the equity market. Let's look at the sector level. Try to spice things up here. We do have some movement to talk about. kind of an even split here. Up at the top, you do have utilities seeing a gain of about 0.6%, real estate up about 0.5%, consumer staples also seeing some gains here. So pretty defensive overall. You go down the list or over to what's not doing so well. You do have industrials, you have tech down, small moves overall. At the bottom here, you do have healthcare down about 0.5%, Romaine, so still pretty quiet.
Interesting to look at some of the individual movers. One of the biggest gainers out there on the day is PDD. That's a company formerly known as Pinduoduo, the Chinese company. And if you've seen all those ads for Temu, that's its shopping app. It came out with its earnings, revenue doubled. The shares up about 20% here on the day at one point on an intraday basis. One of the biggest gainers out there, only really to be bested by Farfetch. Farfetch shares up about 23% right now. This after a report in the Telegraph over in the UK that Jose Neves, who founded the British fashion company, is looking to take the company private. The report out of the Telegraph says it's already working with JP Morgan to do just that. Investors seem to like that, considering that the shares have really not done much of anything over the last couple of years. Meanwhile, Starbucks down for a 7th straight day. No real news there. And keep an eye on Disney, dropping 3% here on the day. This is at the big investor day, or the big event, I should say, town hall event that they're having with Bob Iger. It was interesting. He was sat down with an interview with ABC anchor David Muir, and Bob Iger actually walked back some of his earlier comments that he had made a few weeks ago about potentially selling off assets under the Disney brand, including the ABC channels. I don't know if that was affected because he was speaking to the anchor of ABC, but investors not necessarily liking it. They saw some value, Katie, to spinning off those assets.
Well, let's get deeper into the market right now and the economy with our next guest, who predicted that the U.S. economy would avoid recession this year and says that those same forces that supported economic expansion are going to continue into next year. Joining us now, I'm thrilled to say, we have Ryan Dietrich. He is Chief Market Strategist over at the Carson Group. And Ryan, let's start there. You talk about the same forces. They're going to continue into 2024. What are those forces exactly?
Yeah, Katie, thanks for having me, and Rome, thanks for having me back. You know, you think about it, there's so many things that people are worried about this time a year ago. Inverted yield curves, stocks are pricey, we're going to have a recession, the LEIs, we know all that stuff. What we were saying at the Carson Group a year ago was the consumer is still in good shape. We are aware delinquencies are going a little bit higher. Things aren't perfect. But in our opinion, we're still making a couple 100,000 jobs every single month. Productivity is a big key to this. Productivity the last 2 quarters has been up over 4% annualized. We haven't seen something like that since the mid-90s. We think we're going to have a lot of productivity going forward. To us, a strong consumer with productivity, plain and simple, means there's likely not going to be a recession next year. And that's probably going to be positive still for investors going forward.
Let's talk about how that translates into the markets, because Romaine and I were talking a little bit earlier about how you think about all of these bearish calls that were being made this time last year. A lot of them were predicated on the fact that interest rates are going to have to go higher to deal with that economy. That was right. How the market reacted was wrong. What's your view on how this translates into equities?
You're right. I mean, believe me, there was a lot of negativity just 4 weeks ago. I mean, 4 weeks ago, we're in a correction. Everybody was very worried. But I mean, the market is a forward-looking mechanism, right? I mean, we've had the high inflation. We know that. But we've been saying for a while, look at shelter, look at car prices. They are coming back. So, again, it's not a perfect crystal ball by any measure here. But, again, the yields to us are coming lower, right? The Fed is likely done. We're in the camp again. They can cut. Back to that productivity real quickly here. In the mid-90s, okay, the Fed hiked rates a lot in 94. Then they started to cut a little bit in 95. What also happened, though, we had higher productivity. What did that mean? Wages stayed high and inflation came back down. So again, history doesn't repeat itself, but often rhymes. Mark Twain, we all hear that and use it a lot. There are some similarities right now with the mid-90s. We're not calling for a mid-90s explosion in equities, but we think there's some real reasons to think we can have a couple years, Katie, of strong economic growth and likely continued stock gains. Yeah. We've been overweight equities since last December. We're still overweight equities here.
On that productivity side, I feel like we've kind of gotten a taste of that. We were kind of joking a lot about Mark Zuckerberg's year of efficiency, but that year of efficiency actually proved to be very prescient here, because he basically said, look, you know, yeah, revenue growth might be constrained, but if we can trim a lot of the fat around here, this company will be stronger than it has been. You saw similar moves in Microsoft and some of the other names here. I guess the question, though, is that really going to spread to, I guess, companies that didn't necessarily have the balance sheets and the breadth that Facebook or Microsoft has?
Great question there. And again, we had a lot of productivity right at the start of the pandemic. Why? Because everybody lost their jobs, and a few of us that had a job had to work harder. So there was high productivity there. That's bad. That's bad productivity.
Yeah.
Now we've hired 5 million people last year, another 3 million ballpark this year maybe. There's a lot more productivity. People are trained. They're ready to go. They're ready to help their companies grow. So again, could we have 3% GDP growth next year? We think it's possible. One other thing about everyone said a recession this year. It's a pre-election year. You got to go back to World War II, before World War II. Last time a pre-election year had a recession. So again, it just makes sense that this cycle has a lot of time left, to be honest.
Well, I'm glad you bring up the election cycle because we know that.
Are you? We have to talk about it?
Well, I don't want to talk about the election specifically, but in terms of how it feeds into the market. And I think a lot of people kind of forget that. Politicians do a lot of things during election years, which tends to kind of keep the economy humming. But it begs the broader question, too, as to whether this market is just kind of coming full circle, right? We kind of forget that, what was it, a year and a half ago or something, we were at 4,700 in the S&P. We're just kind of working our way back to that right now. I guess the question is, how much do we overshoot that? Are some of those calls for 5,000 or more really realistic?
We would say they're realistic, and that's a great point. Stocks have really gone nowhere, S&P for a couple of years, to be honest. But this year's really played out. Again, when you have a first-term president in the third year of the presidential cycle, like right now, up about 20% on average. That's ballpark where we are in the S&P right now. Next year, which is an election year, last I checked, when you have a first-term president, the last 10 presidents, stocks have been higher, all 10 of them up 12% on average. It's when you have a lame duck president, look at 1960, 2000, 2008. Now, there are some other scenarios, I get it. But again, there are some reasons to think that, hey, Washington, it is what it is. It's not red, it's not blue, it's about green, getting people happy and keeping the economy going. And those are some levers that Washington can pull, we think, into the next year.
Okay. Well, that's a very optimistic look. I always viewed Washington as brown for like the muck that found there. So, but,
Well, there's a lot of historical reasons to like equities right now. And as Romain said, a lot of optimism coming from you. But what's the biggest risk in your view? What could go wrong in 2024?
Yeah, I mean, listen, inflation, the economy could maybe overheat, okay? I mean, if things keep going this way, then you have a little continued higher inflation, not our base case, but that is one potential worry. And then the Fed, they took their foot off the pedal maybe, although they haven't cut yet. I'm aware they haven't even hinted at that, but the Fed fund futures are saying that. But potentially, could the Fed take their foot off the pedal and then we have an upset alert? That could happen. And then just a black swan, the things that nobody sees coming, we know that. But all in all, things are still pretty good to us.
How in sync are the markets? Because I feel like earlier this year, you really had kind of assets going in different directions because everybody was had different theories about where we were going. Are we kind of more in sync right now?
I think so. I mean, last year was literally one of the worst years ever for stocks and bonds, right? So now it's a little more normal. I mean, bonds are up, the ag's up like a 1% this year, but we know where stocks are. So I think it's getting there. And one final thing on that, everyone's talking about the Magnificent Seven. Yes, those 7 stocks have done amazing. But again, we're seeing a ton of participation since the October lows. Things are broadening out. Again, historically, that's a sign that this bull market has time as more stocks are participating exactly like we want to see, and we're seeing it.
Yeah, breath is definitely not as bad as it has been for most of 2023. Ryan, got to leave it there. Really enjoyed this conversation. That is Ryan Dietrich of the Carson Group. Now coming up, the top 3. It's our new segment where we focus in on the top 3 movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg. All right, it's time now for the top 3. Every day at this time, we do a deep dive into the people at the center of today's top story. Scarlet Fu joining us now. Who do you have your eye on?
I'm keeping an eye on Nikki Haley because the big money is throwing its weight behind her. A super PAC with close ties to billionaire Charles Koch says that she is the best candidate to beat Donald Trump for the GOP nomination. And of course, the former South Carolina governor and UN ambassador to the U.S. UN ambassador has been on quite a roll. She's earned praise from Ken Griffin. She's poached donors from rivals, notably Ron DeSantis, whose star has been fading pretty quickly.
Yeah, it's interesting. I mean, this is going to be, as we really ramp up into the 2024 presidential election, who is putting their money behind who and how much money. Interesting to see some of that drip feed coming through, Romain.
Yeah, it'll be interesting to see how this plays out as we head deeper into the election season, Katie. I've actually keeping my eye on somebody else. This is outside the world of politics, so we go back to the markets here, and it was shares of Twilio. I know that's not a person, but those shares are actually having a pretty good day, and it is largely because of one particular person. You probably haven't heard of him. His name is Sagar Gupta. He was at a previous hedge fund called Legion, which was actually an activist seeking to sort of create some change at Twilio. He left there There was kind of a sigh of relief because the CEO of Twilio, I guess, felt like he had the bear off his back. But he resurfaced at a Toronto fund called Anson. They took a stake in Twilio and now are advocating, for a big change in the board. Now, investors clearly like this, but of course, for most CEOs, this is going to cause headaches that they would rather not have.
Yeah, he thought he got the monkey off his back, and instead now he has to deal with it once again. I was just looking. Twilio, of course, was once a hot IPO, not so much anymore. It has yet to post a profit on a GAAP basis in all the time that it's been public.
Yeah, and this was like a $400 stock, and it's trading, what, in the 60s right now? Yeah.
Yeah, I feel like that's emblematic of a lot of darlings that we saw rise over the past 3 years or so. But let's talk about number 3. I'm talking here about Mark Patrikoff, his firm, and more than 50 of its current and former athlete clients, including Philadelphia Eagles center Jason Kelsey, also golfer Michelle Wee West. They're investing in the sports education company IMG Academy. And
I'm sorry, what? Sports education?
Sports education. So
are you questioning that?
Are these like student athletes?
This is a good question for Scarlett because I had her explain it to me. So it's sports and some undisclosed amount of education.
I mean, it's athletes who are kids still going to become better athletes at this academy, and then they get to go to school too and earn a degree.
They get to go to
I'm
school.
always fascinated by IMG because it's basically, I remember kind of the genesis. The whole idea was that, look, there are people that they want a career in professional sports. Look, you have law schools, you have other trade schools, so why not have one that's dedicated to
China has them all over the place.
sports?
Russia does too.
I understand that, but then like the veneer of education, is that a big component of this?
It's a component. I don't know how big it is, but it's a component.
Yeah.
There is an interesting quote here from Mark Patrikoff himself. He did say that not every athlete who goes to IMG is going to play professional sports, but they do learn a work ethic. So it teaches that. And
they come out with a
hopefully
degree, right?
Yeah.
And that puts them on a path to be able to pursue higher education if they're inclined.
Yeah, and as you point out, and then the thing that also fascinates me about IMG is, like, obviously they're not just trying to create the talent, but I mean, they're actually folding that into obviously a lot with now, of course, with name, image, likeness, and getting agent deals and things like that. So there's a lot of components to that.
They're an entrepreneur.
And I can understand why you would want to invest in it. I mean, because there's certainly, I mean, obviously you talk about some of the big names that have come out of it. You mentioned a couple.
Yeah.
Or you mentioned a couple investors, but a couple of the big names that have actually.
Well, Patrikoff said that his firm in particular, who is also investing, likes to 2x to 3x to 4x our money. So he clearly sees an investment case.
Now, you're an athlete, right?
I'm not quite IMG level.
I know Scarlett's an athlete. You play hockey.
Yeah, nowhere near IMG
She
level.
mountain bikes.
She mountain. Okay,
Yeah,
that's
she's
not really
hardcore.
a sport, though.
Oh, that's a sport.
I mean,
That is a sport.
Hockey's a sport.
No, mountain biking is totally a sport.
All right, when we come back after the break, Scarlett and I will debate whether or not mountain biking is a sport. This is Bloomberg.
All right, it's time now for the top 3. Every day at this time, we do a deep dive into the people at the center of today's top story. Scarlett Fu joining us now. Who do you have your eye on?
I'm keeping an eye on Nikki Haley because the big money is throwing its weight behind her. A super PAC with close ties to billionaire Charles Koch says that she's the best candidate to beat Donald Trump for the GOP nomination. And of course, the former South Carolina governor and UN ambassador to the U.S. UN ambassador has been on quite a role. She's earned praise from Ken Griffin. She's poached donors from rivals, notably Ron DeSantis, whose star has been fading pretty quickly.
Yeah, it's interesting. I mean, this is going to be, as we really ramp up into the 2024 presidential election, who is putting their money behind who and how much money. Interesting to see some of that drip feed coming through, Romaine.
Yeah, it'll be interesting to see how this plays out as we head deeper into the election season, Katie. I've actually kept my eye on somebody else. This is outside the world of politics, so we go back to the markets here, and it was shares of Twilio. I know that's not a person, but those shares are actually having a pretty good day, and it is largely because of one particular person. You probably haven't heard of him. His name is Sagar Gupta. He was at a previous hedge fund called Legion, which was actually an activist look at seeking to sort of create some change at Twilio. He left there. There was kind of a sigh of relief because the CEO of Twilio, I guess, felt like he had the bear off his back. But he resurfaced at a Toronto fund called Anson. They took a stake in Twilio and now are advocating, for a big change in the board. Now, investors clearly like this, but of course, for most CEOs, this is going to cause headaches that they would rather not have.
Yeah, he thought he got the monkey off his back, and instead now he has to deal with it once again. I was just looking. Twilio, of course, was once a hot IPO, not so much anymore. It has yet to post a profit on a GAAP basis in all the time that it's been public.
Yeah, and this was like a $400 stock. stock, and it's trading what in the 60s right now. Yeah.
Yeah, I feel like that's emblematic a lot of darlings that we saw rise over the past 3 years or so. But let's talk about number 3. I'm talking here about Mark Patrikoff, his firm, and more than 50 of its current and former athlete clients, including Philadelphia Eagles center Jason Kelsey, also golfer Michelle Wee West. They're investing in the sports education company IMG Academy. And
I'm sorry, what? Sports education?
Sports education. So
are you questioning that?
Are these like student athletes?
This is a good question for Scarlett because I had her explain it to me. So it's sports and some undisclosed amount of education.
I mean, it's athletes who are kids still going to become better athletes at this academy, and then they get to go to school too and earn a degree.
I'm always fascinated by IMG because it's basically, I remember kind of the genesis. The whole idea was that, look, there are people that they want a career in professional sports.
Yep.
Look, you have law schools, you have other trade schools, so why not have one that's dedicated to
China has them all over the place.
sports?
Russia does too.
I understand that, but then like the veneer of education, is that a big component of this?
It's a component. I don't know how big it is, but it's a component.
Yeah.
There is an interesting quote here from Mark Patrikoff himself. He did say that not every athlete who goes to IMG is going to play professional sports, but they do learn a work ethic. So it teaches that. And
they come out with a degree, right?
Yeah.
And that puts them on a path to be able to pursue higher education if they're inclined.
Yeah, and as you point out, and then the thing that also fascinates me about IMG is, like, obviously they're not just trying to create the talent, but I mean, they're actually folding that into obviously a lot with now, of course, with name, image, likeness, and getting agent deals and things like that. So there's a lot of components to that.
You're an entrepreneur.
And I can understand why you would want to invest in it. I mean, because there's certainly, I mean, obviously you talk about some of the big names that have come out of it. You mentioned a couple.
Yeah.
Or you mentioned a couple investors, but a couple of the big names that have actually.
Well, Patrikoff said that his firm in particular, who is also investing, likes to 2x to 3x to 4x our money. So he clearly sees an investment case.
Now, you're an athlete, right?
I'm not quite IMG level.
I know Scarlett's an athlete. You play hockey.
Yeah, nowhere near IMG level.
She mountain bikes.
She mountain. Okay,
Yeah,
that's
she's
not
hardcore.
really a sport, though.
Oh, that's a sport.
I mean,
That is a sport.
Hockey's a sport.
No, mountain biking is totally a sport.
All right, when we come back after the break, Scarlett and I will debate whether or not mountain biking is a sport. This is Bloomberg. This is the countdown to the close. Romaine Bostick here alongside Scarlett Fu as we count you down to the closing bells and take you to the bell and beyond. And the price action today, Scarlett, well, I guess, forgive me if you heard this yesterday, seems a little bit tepid.
Yeah, definitely is. And volume is down once again as well. In the Dow, 14% below the 20-day average. It's the 5th day that the S&P and the NASDAQ has moved less than half of 1%, even though there's been quite a bit of Fed speak, and notable Fed speak at that. You had two hawks talking.
Well, yeah, a lot of substance coming out of Waller, and then, of course, Austin Goolsbee kind of making the case here that maybe the Fed has done enough.
And Bowman.
Although Bowman seemed like she was hedging her bets here. She seemed to be suggesting that, the Fed, I don't know if that was just sort of the public window dressing to make sure that the market doesn't actually sort of take her too seriously, but she definitely made it clear that she thinks the Fed might need to stay the course. And I think Barr is supposed to speak at some point later today. So
yeah, so
I don't know, is that enough
Fed
Fed speak for you?
That's plenty of Fed speak.
Did you learn anything today?
Well, I learned that Waller is increasingly confident that policy is currently well positioned, however that means. As long as inflation keeps going the direction it's going in, they're comfortable with where things are at. So it all depends on the PCE report that's coming up.
Well, did you see, though, some of the pricing in the options market and the SOFR market with regards to Fed cuts next year?
Yeah.
I mean, that's just gone through the roof. And I don't understand how you square that circle. Like, if the economy's strong, then why should I believe that the Fed is going to cut rate multiple times over the next, 12 months?
Well, I mean, if you believe that, for instance, real yields will be doing something differently, or a recession will come and the Fed will have to respond, then perhaps the Fed would need to cut. It's a big debate right now.
I used to believe in Santa Claus, too.
Stock market investors and the bond market investors don't necessarily see eye to eye on things.
All right, let's see what Ben Kirby thinks. He's joining us right now to help count down to the closing bells. Ben Kirby, Thornburg Investment Management's co-head of investments. And Ben, this isn't the debate Scarlett and I are having isn't really just for show here. I mean, this is really playing out in the market, and you have different pockets of this market that, one side that is pricing in much better economic times, and you still have certain areas of fixed income that seem to be pricing in a recession.
Hi, Romaine, Scarlett. Thanks for having me on the show. That's exactly right. So equity investors are still pretty optimistic about the future. The market is trading at 20 times earnings, and we're expecting 10% earnings growth into 2024. That would be above long-term trend and above long-term valuation. At the same time, the bond market is pricing in 4 rate cuts over the next 12 months. So those two scenarios, it seems hard for both of those to play out simultaneously. We're going to have to wait and see who's right.
Certainly so. And this gets to the broader question, though, about, I guess, the general trend that we see. Obviously, equity investors kind of by default tend to be a little bit more optimistic in the way they look forward. And bond investors have much more of an incentive to be a little bit more scrutinous of conditions, given the liabilities that are attached to some of those investments here. Are we at the point now, though, where we're going to see a broader divergence in the market, or do you think we're going to see a bit more of a convergence as we get more clarity from the economic data and hopefully from the Fed itself?
Yeah, so look, I think we're in a new monetary regime. I think this is Fed 2.0, or maybe it's back to the old normal, if you will. There used to be a school of thought that as soon as the economy slows, the Fed is going to swoop in and save the day and cut rates. And given that core PCE is still 3.7%, that's a long ways away from 2%. So we think that in the current environment, the Fed wants to see inflation below 2% and stay below 2% for a while before they're likely to cut rates. So that makes us think that probably the bond market is a bit too optimistic on those rate cuts, or conversely, maybe they're too pessimistic on the future state of the economy.
Yeah, below 2% is a lot different than 2-ish%, which is what a lot of people were thinking about a couple months ago. I'm curious to get your take, Ben, on the November rally that we have seen, in which we've gone from oversold to overbought inside of 1 month. To what extent does liquidity explain this November rally?
I think it's liquidity, and I think it's the end of mutual fund tax loss selling in October. That definitely had the market pressured, and a lot of money comes back into the market. The other thing to remember is that typically 6 and 12 months after the last Fed hike, markets tend to have positive returns. And in particular, dividend strategies tend to have very positive returns in the 6 to 12 months after the Fed rate hike cycle. So I think that the last hike we had was back in July. We're already 4 months into this period. The market is sniffing out the end of the hiking cycle, and that tends to be risk asset positive, at least until the slowdown comes.
Yeah, but the dividend strategy has really not played out at all this year. I remember at the start of the year, everyone was talking about how you want to get paid, these quality companies that, can set aside enough money to return it to shareholders. That has not borne out. Everyone's still chasing the big cap growth stocks.
Absolutely. So AI was a surprise in the last 12 months, right? Nobody expected NVIDIA to put up the numbers they put up, and that really took the market up about 500 points, just kind of all by itself. That said, dividend investing is a sound long-term strategy. We have a lot of studies that show that over a very long time period, companies with dividends, and those especially that are growing dividends, outperform the market over time. So we still think, especially as we go into a slowing economic environment, you're going to want those companies that have good balance sheets, free cash flow, durable businesses, and that pay dividends. They're just going to be a lot more resilient as things start to slow.
I do want to talk a little bit about some of the correlations with, for example, in the Treasury market to equities, as well as to FX and equities as well, because that also seems to be driving a lot of investment decisions these days. Let's start with the dollar, because that could have an outsized effect in terms of where will you invest geographically, but also the types of companies you invest in as well. What's your base case for where the dollar goes, and how does that factor into your decision?
So there's a few inputs to that. One is that from a purchasing power parity basis, the dollar is expensive versus international currencies. It's probably 20% expensive versus the euro. It's probably 40% expensive versus the yen. So look, it's a great time to go on vacation outside the U.S. Your dollar's going to buy a lot of travel and leisure. That being said, if we do go into a recession, if we do get a slower economy, the dollar tends to be strong in that environment. So I think that probably the first order effect is going to be that slowing and that risk aversion. And then as we come out of it, I would expect to see some significant dollar weakness over the coming 5 and 10 years.
All right, Ben, always great to talk to you. Ben Kirby, Bloomberg Investment Management, co-head of investments there, roughly about $40 billion under management here. And we talk about, Scarlett, this idea as we get closer to the closing bells, whether the different asset classes are kind of communicating different things about economic conditions and the Fed.
Yeah, absolutely. I mean, you look at oil prices, and it seems very much keyed off of what's going on overseas. For instance, China, and of course, how OPEC Plus decides to play out with regards to production quotas. Saudi Arabia obviously doing its part to push for more quotas and more production cuts, and maybe everyone else resisting. And that relationship with the dollar, which hasn't always borne out.
Yeah, it hasn't always borne out. And look, everyone always sort of says, okay, King Dollar is now dead. And then it sort of lets you know why it's called King Dollar. We are moving closer to the closing bell. Stick around. Full market coverage is coming up right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with our friends Carol Masser and Tim Stenevik. We want to welcome all of our audiences across our Bloomberg platforms as we walk you through all of the market action of the day and set you up for some big earnings coming up after the bell. But Carol, before we get to that, we have to flag a story crossing the wire right now. We have learned that Charlie Munger, over at Berkshire Hathaway, has passed away. Of course, Charlie Munger, the longtime business partner of Warren Buffett, has passed away. Our headline on the terminal right now is that he died peacefully.
Yeah, which is a good thing to hear that that's how, because we know it can be often so difficult. But what I think about is these two individuals, right? In terms of the investment climate, you think about Berkshire. Of course, we think of Warren Buffett, but really these two individuals went hand in hand when it came to creating Berkshire, the Berkshire that is today, and just iconic when it comes to the world of investing. And Graham and Dodd, you think about that approach, value investing. We just had a guest on, Bill Smead, talking about following what Warren Buffett does. It's just been iconic for any of us who've covered business news for a long time. I feel like these two individuals we have constantly followed very closely in terms of what they have done.
And just a couple more details here. So this is coming from a family statement saying that Charlie Munger died peacefully this morning at a California hospital. Of course, he was 99 years old, just actually a month or two shy of his 100th birthday. All right, we are going to try to find some more details about this and obviously the legacy of Berkshire Hathaway and really the partnership between Charlie Munger and Warren Buffett and some of the comments that Buffett has made over the years just about how fundamental Charlie Munger was to his success personally and how it really reshaped his life and, quite frankly, ended up building one of the powerhouses in the world of investment management. We do want to walk you through the closing bells here in New York. The Dow Jones Industrial Average higher on the day by about 0.2%. The S&P 500 is going to close higher by 0.1%. The NASDAQ up by about 0.3%, and the Russell 2000 in the red on the day, down by about 0.5%.
Well, and I'm just thinking, I'm going to look at Berkshire Hathaway, which, obviously we look at it. It's always been such a great gauge in terms of the overall economy. Berkshire Hathaway shares, by the way, they are up about 17% year to date, just down a little bit lower in today's trade, Scarlett.
Yeah, and just to follow up on what you're saying, a statement coming out from Warren Buffett, who, of course, is Charlie Munger's partner, the CEO of Berkshire Hathaway, saying Berkshire could not have been built to its present status without Charlie's inspiration, wisdom, and participation. Once again, Charlie Munger peacefully passing away at the age of 99.
Before we get to some of those numbers, though, it was always such a treat when you watched the
Charlie Warren show,
the meetings, where they would kind of sit there with their Coca-Colas and just take questions and just the frankness. And you kind of forget just how rare that is in the investment world to get kind of more unvarnished opinions about the state of the world.
Maybe crypto. Charlie Munger never holding back on crypto.
Yeah, and it was refreshing. And of course, a lot of people really kind of wanted to replicate whatever they were chasing after. Obviously, mixed success in doing that. But, they were certainly an illumination and certainly a light in a world, in an investing world that I think it sometimes can be very, very opaque.
They made investing look fun.
Yeah.
Fun and not complicated, right? I mean, the concepts were pretty basic, right? You make a bet on something, you look for something with deep value, and you hold to it. And they brought a certain lightness to it, I want to say.
Yeah, it was all about those fundamentals. And they would say over and over again that they would go through so many companies, their balance sheets, their income statements, all the SEC filings. And if it didn't fit their definition of value investment, then they would just pass on it and move on to the next one. And they would hold it forever. And they've proven that over and over again with companies like Coca-Cola and even, increasingly newer companies like Apple and Occidental
Well, I was
Petroleum.
going to say, very pragmatic, right? They
Yes.
wanted to understand the business, really understand the business. And it often was kind of things that we all could relate to. But they also evolved. And you think about other individuals they brought into who in later years were very much a part of the Berkshire investment strategy. And that evolved to something like an Apple. So it did show how they too could kind of embrace different strategies, different types of companies.
Well, isn't that like kind of the beauty of it too, right? Because we talk about as they were getting up in age and there were a lot of questions about the investment decisions they were making, that they at least were aware enough of their own limitations to hand off some of those responsibilities to Greg Abel and Ajit Jain and a few others who, of course, helped to make some of those calls, like on Apple as well. So, I mean, these are folks who are obviously very smart, but also smart enough to understand kind of when it's time to sort of pass the baton. And I know they were getting up there in age and they stuck around, but, let's face it. I mean, this is a business that, to a large part, has been run by their deputies for quite some time. They were certainly the figureheads and certainly comforting and a welcome presence, I think, every time we saw them on screen.
Oh, yeah, but Charlie Munger could have done so much. I mean, early in his career, he was a lawyer. He started a law firm that is still active in California today, moved on into the investment world, and even as he aged, he continued to, as you said, Romaine, as you said, Scarlett, continue to be vocal about stuff he believed in, stuff he didn't believe in. So many other folks could have spent the last 30 years, you approach that age and retire and actually completely move on from the limelight. But Munger and Buffett, they just chose not to do that.
Well, this is what they love to do, right? And it came through in everything they said. One thing, and Carol, you mentioned this, they invested in what they understood. If they didn't understand it, it's something that they wouldn't put money into. One thing that's notable, I'm just looking up a story here. Munger, of course, Warren Buffett's investing partner, but he has sold or donated more than 3/4 of his Berkshire stock over the years, giving a lot of it to his alma mater, University of Michigan, for instance. So when you just look at the wealth numbers, perhaps not as wealthy as Warren Buffett, but certainly he gave a lot of that away.
And we talk about, too, I mean, we were mentioning Apple and sort of the big decisions that Greg Abel and the others sort of made. But we kind of forget that some of those early investments that really sort of made Buffett who he was and Berkshire what it was actually came from Munger. We talk about See's Candy and the influence that Munger, I mean, Buffett has been very vocal that he actually wasn't all that interested in it, but it was Charlie who really sort of sold him on the idea that not only was it a value play, but that it was a long-term value play as well. And they bought into that back in the 70s. Geico, of course, another one that Munger was also apparently behind. So some really prescient picks by him, and I'm sure with the consultation of Buffett and some others as well.
Yeah, go ahead, Carol.
No, but it's interesting how we talk about the evolution of their thought. And I think about how much, Berkshire Hathaway has invested in some of the big bank names, right, for a long time and held fast to it. But, during some of the turmoil earlier this year, you did have Charlie Munger talking to the Financial Times specifically in an interview and talking about, bad loans and being critical of a sector that they have long been invested in. So I do feel like, when it's in times of crisis, we felt like this with Warren Buffett during the financial crisis. These were individuals that had seen a lot of market cycles, understood the markets, and that whatever was going on, whether it's crypto, whether it's a crisis, you wanted to have these individuals weigh in.
Yeah, our own Noah Buhire writing in the obituary, Romaine, that Warren Buffett has credited Charlie Munger with broadening his approach to investing beyond what Benjamin Graham taught them back at Columbia, buying stocks at a fraction of the value of the underlying assets. He started with Munger's encouragement, buying insurance companies, railroad companies, manufacturing companies, consumer goods, all the way through, their many, many decades together.
Yeah, and it was like in the biography, they talked about this idea, or Buffett talked about the idea that before he really partnered with Munger, he was doing that, quote, cigar butt strategy, the idea that you were sort of looking for value. But the thing is, as you know, things that are cheap don't necessarily mean they're good investments.
Right.
And Munger was really the one to say, look, you might have to go up a little bit in price because, yes, those things might look more expensive on the surface, but underneath there's better long-term value with the key focus on long-term.
I think Apple's such a good example of that. Many people saw them as relatively late to the Apple trade, and look how much Apple stock that Berkshire Hathaway owns at this point.
Well, they needed to do their research on it. They needed to do their work. They needed to make sure that it was a right kind of investment that fit into their portfolio before taking a big position in it.
You know, it's interesting, a story like this, and we think about these companies that are so tied to iconic leaders, whether it's Warren Buffett and Charlie Munger, who've been so tied to this company, and you think about what they have done, though, over the years to bring in the next generation to ensure that this is a company that continues forward. And so, obviously, the legacy of Charlie Munger will stay on Berkshire Hathaway for a long time, but they've also, as we said, you know, passing the baton to make sure that their investment strategy is certainly incorporated into kind of future environments.
Yeah, and of course, the succession planning has, been long in the process, and we know, Romaine, you mentioned, the succession plan at Berkshire Hathaway, and increasingly in recent decades, I think it's fair to say the two of them have taken a less hands-on approach.
Yeah, a less hands-on approach, obviously given their age, and it's interesting too. I mean, I didn't realize. I always looked at Munger as kind of like an LA guy because there was always that talk. There was that friction early in their relationship because
he's a Nebraska
Buffett
guy.
He's from Omaha, too. But you kind of forget that sometimes, given that there was always that talk that Buffett was still out there in Nebraska while Munger was out there in LA partying. But obviously, look, I mean, I don't know what he was doing, but at the end of the day, it's interesting to see not just an investment giant, if you will, but also just the partnership, right? And how hard that is to maintain that type of relationship over the course of from the early
Decades.
60s to whatever now, you do the math on that, and for it to be successful, and more importantly, to actually leave behind something that's probably going to even be better long after they're gone. And that's probably more of a hallmark of just how good of managers they were.
We think about relationships, right, that we have at work, wherever, our personal lives. But looking at Noah Buhayer's story, he said, this is from Buffett, he said, it's terrific to have a partner who will say you're not thinking straight. This was at Berkshire's 2022 meeting, and he just talks about too many CEOs surrounding themselves basically with people who don't challenge them, and so that was the core of their relationship. And obviously, you just look at where Berkshire Hathaway is and the company that's been created and how significant it has been in the investment world and really the world at large. So
they kept each other honest.
They did, right? And those relationships are just, you can't put a price on it. Sad day, no doubt about it, and something we think about certainly in our world, but the world at large. All right, guys, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals. Once again, Berkshire Hathaway saying Charlie Munger has died.
All right, stick with us here on Bloomberg Television. Of course, the big headline crossing the terminal just a while ago, Charles Munger, the vice chairman of Berkshire Hathaway, has passed away peacefully at the age of 99. That statement coming from his family. After the break, we'll take a deeper dive into his legacy and what he and Warren Buffett built. This is Bloomberg. Welcome back to The Close here on Bloomberg. A sad day in the world of investing. Charlie Munger, the vice chairman of Berkshire Hathaway and the longtime partner of Warren Buffett, has passed away at the age of 99. He was just about a month and a half away from his 100th birthday, raising a lot of questions right now about the legacy of what he and Warren Buffett built, and more importantly, about the future of Berkshire Hathaway under its new leadership. Sonali Basak joining us right now, our Wall Street beat reporter, to talk a little bit more about what's going on here. And let's start off with his legacy. We were just talking with our radio colleagues, and we kind of fondly remembering just how frank Munger can be, and Buffett for that matter too, just about economic conditions, about politics, about whether he thought a stock was worth something or just completely worthless here. It was a level of transparency and a level of honesty, quite frankly, that you don't always get on Wall Street.
Yeah, you don't always get it on Wall Street, and you don't even always get it from Berkshire Hathaway. You saw him at every annual meeting sitting next to Warren Buffett, and they would almost answer each other's questions. The one time he wasn't there, in fact, Buffett even brought a cardboard standout of him. And so he, in a lot of ways, was the confidence of Berkshire Hathaway. He was a key part of the investing philosophy, importantly, even kind of helped nudge Berkshire when they were uncertain to buy certain assets, like See's Candy, for example, which is such an iconic brand.
And I'm fascinated by the See's Candy thing, because, I mean, this was pretty much his idea. I mean, Buffett was really against it. He thought it was too expensive. And Munger was the one who said, you really have to rethink what value is. And Buffett kind of cites this, right, in his I think it was the 2015 book, right, where he kind of talks about this idea of how he was wedded to the philosophy of Benjamin Graham, but he kind of came to the realization at Munger's urging that things had just changed. The world had changed, and some of that philosophy just no longer applied.
And you saw both of them kind of play off each other in that way, even in more recent years in the way that they've thought about what they knew and didn't know about the technology industry. Another thing about this, to your point on the colorful language, because that is really something that everyone will remember him for. He really did call out bad behavior on Wall Street. He criticized banks for gambling at different times and Bitcoin and crypto industries for being like poison. He really had strong words, and those are the kinds of sentiments that when you are looking for the opposite of value, froth growing in markets, who is going to call that behavior out again?
Yeah, well, he's in a position where he wasn't beholden to anyone or anything when talking about the possibility of investing in different companies. I'm just looking up a couple of his most famous quotes, and there are a couple here that are really great. Knowing what you don't know is more useful than being brilliant. Something that I think everyone can understand. When it comes to investing, there's a lot you won't know, but you have to go with what you do know and what you don't know, and being humble about that, right? Having the humility to move forward with that. Take a simple idea and take it seriously, for instance. In the story that our Noah Buhayer wrote on Charlie Munger, he described Munger as acerbic, which I really like because it's kind of the balance to Warren Buffett and how excitable Warren Buffett can get sometimes.
Yeah, absolutely. And you have to think about just how far they've come in building Berkshire Hathaway. If you think about Berkshire in and of itself, how many businesses on Wall Street are now essentially Berkshire copycats? You think about that even with Apollo, the way that they bought insurance companies and used the float to make the businesses more profitable, to be able to kind of lower the cost of capital across the businesses. This wasn't just about what they did in terms of how they invested in certain stocks. The way they built the Berkshire business model by the end of it was supposed to be the best view of the American economy that you could have, the most ability to invest in those value trades, but invest in it in a way that you can operate them well. And remember, Munger, who was also a lawyer by training, a real estate lawyer, was kind of a critical part of that practical way of thinking as they made Berkshire what it is today.
You know, as we talk about what happens at Berkshire Hathaway, the succession plan that everyone is always reading into, how much did Charlie Munger come up in those conversations? It really felt like everyone was looking for the successor to Warren Buffett and less understanding what Charlie Munger's role was within that.
Think about it in two ways, right? Because he was Buffett's right-hand man. And you have Buffett himself, who is now 93. You have Ajit Jain, who is the minds behind the insurance operation. Now he is 72. You have really Greg Abel here, who has been anointed as the heir apparent for many years. He is only 61. And that the future of Berkshire Hathaway, the succession planning every year comes into question, has slowly been brought into the planning atmosphere of this. But really, the idea of Berkshire having Munger as the vice chair was really a matter of checks and balances and building a broad-based business with a lot of input into leaders that have grown together for such a long time.
And who trust each other.
Exactly. And so it's not that Munger was going to take over Berkshire Hathaway. That was never really the thought here. But, you know, the next generation, how do they lean on that partnership and discourse that Munger and Buffett brought to each other?
And talk a little bit, though, about just the discipline. Because that was always kind of the hallmark, whether it was sort of maybe a little exaggerated, but we talk about the cash pile that they're sitting on today, but we've been here before in other cycles, and Buffett's been very vocal about that, is that you don't really jump until you really do see value. If you have the cash, it doesn't mean it's burning a hole in your pocket.
Yeah, I think that's an important part of this whole story, isn't it? Because they've been criticized over time on having that much cash and how they've used that cash. And remember, I think a private equity part is very important of this. The copycats you're seeing, the Apollos of the world, for example, because they have competition these days that they didn't have back then in terms of other cash piles that are now sitting around too. To the point that you're making here, they have been very disciplined. They're sitting on near record cash hoards today. And they themselves, both Berkshire and Munger, have gone back and forth on the opportunities they've missed, but they've also said that if you don't know, you don't jump in anyways. Yep.
All right, Sonali Basak, who covers Wall Street for us, here on the life and legacy of Charlie Munger, passing away at the age of 99. We'll have more coverage coming up in a bit. This is Bloomberg. We want to go back to our top story. Charlie Munger, the longtime business partner of Warren Buffett over at Berkshire Hathaway, has died at the age of 99. A statement from his family saying he died peacefully at a California hospital earlier today here on November 28th. To cover the life and legacy of Charlie Munger, his business partner Warren Buffett, as well as the future of Berkshire Hathaway, is Bloomberg Finance editor Michael Moore. And Michael, we were just talking with Sonali a little bit earlier here about some of the more colorful times that Munger gave us over the years. There's now kind of a push forward. They set a succession plan up a long time ago. We know that Greg Abel and a few of the other deputies have been making a lot of the investment decisions as of late. Give us a sense here as to how the passing of Munger might actually accelerate that transition.
Yeah, so as you mentioned, Greg Abel has been running a lot of the operating businesses. He's taken a more active role. You know, for years, the annual meeting was the Warren and Charlie show, and they were very entertaining. You know, over the past couple of years, Greg has gotten to answer a few more questions and let investors kind of see his thought process as well. So I think, you know, given that Charlie won't be there at the next annual meeting, you might see more of Greg, you know, alongside Warren answering some of those questions. And, you know, many people said, you know, they took too long to set up a succession plan, but given that they have both worked into their 90s, that's allowed them the time to do this very step by step.
Yeah, and a very long life, 99. I think Buffett is 93. And we should point out, I mean, those plans were put in place several years ago. I know people wanted to maybe see a faster transition, but it's been there. And it's funny you bring up the old idea of people at these annual meetings basically saying, hey, we want to hear from Abel and those guys. They gave them a little bit more of a platform over the last few years. Even I was looking back, you go back to 2019 and 2018. We're allowing those guys to really articulate what was actually happening and why those decisions were being made.
Yeah, especially on the more detailed questions about the energy businesses, the railroads. That's where Abel has really stepped up. But you really felt that Charlie's viewpoints helped shape this company, and he was very big on not chasing fads, on investing in businesses that you know. He was very anti-crypto and had a lot of very colorful comments around that. But it was about even, you know, they were late to some of the tech investments because they said we like to fully understand what we're investing in, and if we miss a couple opportunities, we're okay with that.
They're okay with that, and I think about what Munger has said about Costco, for instance, which Berkshire sold off in 2020, but Munger owned and said he would never sell any because he believed in the business model. He believed in this idea that what they did was better and cheaper than what anyone else did. The value that they offered, it very much aligned with Berkshire, the company. Why is it that Berkshire Hathaway was so much more Warren Buffett than Charlie Munger, even though Charlie Munger played such a critical role in shaping the investment philosophy of the firm? Is this something where Charlie Munger kind of let Warren Buffett take the spotlight?
I think Charlie was okay with Warren owning the spotlight. You know, as he said, my job is to, you know, play foil and you know, keep him in line when I think he's doing something wrong, which he said was very rare.
I'm honest.
Yeah, but Charlie also, you know, had his own ventures as well outside of Berkshire as well, and so I think they were both comfortable with the dynamic.
All right, Michael Moore helps lead our finance coverage here at Bloomberg. Talking right now about the life and legacy of Charlie Munger, the longtime business partner of Warren Buffett over at Berkshire Hathaway. Munger passing away earlier today, we learned from his family at the age of 99. We do want to get some insights out of Bill Smead. He's the founder and chief investment officer over at Smead Capital Management, a longtime investor in Berkshire Hathaway, and you've been attending those Berkshire meetings for at least the last decade or so. Appreciate you taking time for us. Just give us some sense here of what it was like to be at those meetings, which always just drew so much media attention, primarily because of those two men on the stage.
More brilliance and great humor at the same time than you could just about ever put in one place at one time. Charlie Munger and Buffett were a great duo, and Charlie was more acerbic, and he didn't suffer fools wisely. You know what I mean? He would say what he thought all the time and wasn't afraid of the backlash. Whereas Warren is a guy that he's liked and likes to be liked, whereas Charlie didn't care.
Well, that's what I find interesting. I mean, when you go back to the Buffett on Buffett and you go to some of the other books written about him, there does seem to be an interesting yin and yang between those two. And I wonder that had they not been, I guess, somewhat opposites in a way, would that relationship have worked in the same way?
Yeah, they were about 7 years apart, but they both worked for Warren's uncle's grocery store. And then they ran into each other at cocktail parties in Omaha. And what changed, and what the powerful thing that Munger did for Buffett was that when he got done working for Ben Graham here in New York City, he started his partnership. He had a massive information advantage. And that caused him to make huge returns in his partnership. Well, by the 60s, that information advantage started to disappear. He distributed the proceeds, the cash from his partnership, and just kept the Berkshire Hathaway shares and started running Berkshire Hathaway. And then he ran into Munger, and Munger convinced him that his advantage was decision making. You know, here we are, we're making a big deal about artificial intelligence. Well, Buffett, once you've done what Buffett did for 30 years, that algorithm, that wonderful a compilation of experiences and similar situations. He said, now you're going to make your money from making better decisions. Yeah. And that's when they started buying large positions in wonderful companies and not worrying as much about the price because they were going to hold for 20 or 30 years. And Munger's favorite thing to Buffett was if you buy a 5% return on equity business and you buy it at a wonderful price, you're not going to get all that great of investment result over 20 years. If you buy an 18% return on equity business that stays that way for 20 years, even if you overpay for it, you're going to get a wonderful investment. And that's what he did. He helped Buffett pivot to decision-making advantage away from information advantage.
Can you give us an example of, you mentioned Charlie Munger was acerbic and would really not care too much what people thought about how he spoke and how he shared his feedback. Can you give us an example of where Warren Buffett might have leaned one way, but because of the Charlie effect, you pulled him back a little bit?
Well, first of all, one of our favorites was he was a Caltech grad, and so he did the Caltech podcast thing, and they asked him about climate change. And he says, I think we should just build a seawall. I mean, just think how contrary that is with today's thinking. He's in California. Yeah. Well, let's just build a seawall, and why worry about the ocean going up? And so Buffett, just think about it. They own the largest energy utility in the United States. Berkshire Hathaway Energy is a huge utility, gas transmission lines. They're spending $3.5 billion putting wind and solar in Iowa right now. And so that striking that balance between Charlie's seawall and Warren knowing the realities of and dealing with the realities of public opinion on climate change was a balance that they found. And they've done very well in that energy business.
How does Berkshire Hathaway change now that Charlie Munger's out of the picture? How do you see this going forward for the next few years?
Well, I hope it's not true, but it's like a business marriage. I hope it's not like it is with spouses. Sometimes you lose a spouse, so Warren's 93. He's got two very talented stock pickers working for him, and I would imagine that will bring not only the guy running the business side. Sorry, I'm at loss for words at the moment. Yeah. But they'll probably bring Todd or Ted up on the stage to do the annual meeting. One of the other stock pickers, maybe both of the other stock pickers, will come and join him for the conversation. And we're looking forward to that. In our opinion, that's been one of the weak links at the annual meeting is why are we not learning more about the logic? We know everything about the logic of Charlie Munger and Warren Buffett. Right? They're probably the two most studied stock pickers of all time.
I'm curious, and that's a great point. And I am curious, too. I mean, there was a level of transparency there on some of those investments. There were some that kind of went awry as well. I mean, obviously, the Kraft Heinz deal, which Munger has been very vocal that was a mistake in hindsight. So they have had some pretty major missteps. And I wonder what your thought process is about how they sort of addressed that, and more importantly, how they rectified it.
Well, it's great that you mentioned that, because I don't think people understand the mathematics of common stocks especially as it pertains to what they call alpha in generation of excess return. Munger and Buffett figured out a long time ago that you hold your winners to a fault because that compounding effect is powerful. So if you buy a stock at 30 and it goes to 0, you can lose 30. If you buy a stock at 30 and you sell it at 90 and it goes to 210, you lose 120, 4 times as much loss of alpha, right? So they understood that. So you can't really focus very much on the duds. They're going to have 30, 40% duds. That's the way it works. And we've been more concerned with, back in 98 letter to the 97 year, Buffett called Gillette and Coca-Cola the inevitables. Well, that was a pretty good time to sell the stocks. Well, this last meeting, he said Apple's the most wonderful company I've ever seen. Well, that's kind of a contrary signal, right? That's what he did with Coke and Gillette. And so we're not very optimistic about what Apple's going to do, but he's already made 10 times his money, so what does he care? He's already made that alpha that matters.
Gotcha.
What do you think? Is there a 2023 equivalent of Charlie Munger as we think about his legacy? Is there someone anywhere in the investment world that's
shaking your head already?
There is no Charlie Munger out there. Charlie Munger. We call our podcast A Book with Legs because that's what his family calls him. He's always got a face in the book, a book with legs. And those guys read and read and read, and then they know all the history of what's gone on in the last 80, 90 years in the markets. And so just think how powerful, they say that history never repeats itself, but it rhymes. Well, they know the rhymes better than anybody, and they trust the rhymes. Most people don't trust the rhymes.
They were students, though, too, because I mean, no one. I mean, they lived and breathed that stuff. It wasn't like, oh, we're just reading this as an academic exercise. I mean, this is all they really cared about.
Passion. Loads of passion.
Absolutely.
Fantastic. Yeah.
Bill, really appreciate your joining us, sharing some of the stories from your time attending the Berkshire Hathaway annual general meetings.
We'll miss Charlie.
Well said. Bill Smead of Smead Capital. Thank you so much.
Thank you.
All right, well, in addition to his critical role in building the business of Berkshire Hathaway, Charlie Munger was also known as a very generous philanthropist. And that's where we want to turn to now, philanthropy. It is Giving Tuesday after all, and we want to take a broader look at the trends in philanthropy this year. Joining us now is Eileen Heisman. She is CEO of the National Philanthropic Trust. Eileen, how are you? Thank you for joining us today.
Thank you for having me. It's great to be here.
Before we get to Giving Tuesday, I would just like you to talk a little bit about the role of men like Charlie Munger and the role he played in philanthropy, because he was very much a generous donor, especially to his alma mater, to University of Michigan. He's done a lot in the university systems for higher education. Can you just give us a sense of perspective here when it comes to Charlie Munger and the giving that he's given over the years?
It sounds to me, and I haven't studied his giving, but that when you're loyal to your alma mater and you're engaged in your community and you stick with places that you really like, charities that you really like, and you're involved with them, usually your money's well spent and you're a trusted longtime donor. And there's nothing more important for organizations, especially in education, healthcare, and kind of basic social services, to have donors who are very loyal to you. And I just want to say I'm also a graduate of the University of Michigan, and it's a school that really generates a lot of great individuals who are first generation college grads.
Very well said. Thank you for sharing that. So let's talk a little bit more, Eileen, about philanthropy this year in 2023. We know that giving to charities was down in 2022. It was not a good year when it comes to the markets, and there is a correlation between the financial markets and giving. What is 2023 shaping up to look like?
We had a slow beginning. The market didn't start picking up till the middle of the year. We're seeing a lot more activity now. Of course, Giving Tuesday is a big burst of activity. But when the market recovers, we do see people giving more. We actually at NPT get a lot of appreciated publicly traded securities. So we actually see on those days a boost of that kind of gift coming into NPT. So it's a time that we know when the market goes up, people feel wealthier and they give more money. Sometimes people actually time their gifts, and we know that towards the end of the year, when the market's up, we're going to have a greater abundance of gifts.
I am curious as to where do you see, in terms of demographics, where do you see actually most of the money coming from? Is it largely from wealthier folks, or do you see maybe a little bit more contribution from middle-income people?
You know, middle-income people were really hit hard by inflation and also interest rates. And so we see a lot of money from the high net worth activity of those kinds of donors. And we know that over the last 15 years, 20 million fewer average American households are giving. So giving is down, not just because of the last year, but the whole market has changed. And so the high net worth are really, really a big portion of giving in the last 5 years.
Talk to us about, I guess, the ways that we go about this. It's changed a lot. I can even remember when I started my career, it was a much different process if you decided that you were interested in a charity. Now you have all kind of websites that will kind of aggregate things like that. I mean, what is kind of the most efficient way to do this for those folks who are looking to do it?
You know what? I would talk to your friends and family. I would look at the leadership of the charities you're looking at, and I would pick the causes that are really important to you. Don't feel like you have to reinvent yourself every Giving Tuesday or every year end. You should stay with charities, give fewer, larger gifts, stay with them. You know, you should ask the young people in your family, go to the kids' table during the holidays and say, what are you interested in? And you can get a peek into what they're going to be doing. But you should stay with as a loyal donor to the things that are really important to you. And you can give online in nanoseconds practically. So it's the act of giving actually itself. The transaction is much easier, but the research, you need to spend at least 15, 20 minutes. And if you're really studious, you can be like Charlie Munger and have your head in the research for hours.
Yeah.
You really can. And I think if you're a really serious philanthropist, that's what you usually do. You don't spend 5 minutes, you spend hours doing it.
We talked about the markets and how they are certainly an influence on how able people are to give, and inflation really hurting people's ability to give. Can you just give us some perspective on the organizations, the nonprofits themselves, and the charities and the struggles that they've had with these same macro conditions, with the same market instability and the inflation, so that we have a better understanding of how they are using the funds that they do bring in?
You know, that's a really good point. You know, inflation hits everybody, and it hits nonprofits, but it also hits the donors. So they're raising fewer dollars, but they're having pressure to give bonuses and to give raises and to not have flat, at salaries. And things cost more. Everything costs more in the charity, just like everybody else. And so while the expenses are going up, the needs are great. You know, you have less resources to do it. So charities can really be stuck in a very tough place in these moments. And you need really responsive boards. So you need really responsive donors, and you need really smart management. And a lot of people think overhead is terrible. I think overhead is some of the most important money you can give to a charity. That's how you do strategic planning. It's how you get good equipment. It's how you train your staff. And so when you're giving, don't feel like you have to give to a project. Give to overhead.
All right, Eileen, going to have to leave it there. Great place to end it. Eileen Heisman, she's the CEO of the National Philanthropic Trust here on Giving Tuesday. Coming up here on the program, we're going to talk with Amazon Web Services CEO Adam Selipsky. Stick with us. This is Bloomberg.
So the numbers are in from Cyber Monday, and it's looking pretty good for Amazon. Surprise, surprise. Bloomberg's Abigail Doolittle has the numbers. Abigail?
It's really looking great for all e-commerce platforms, Scarlett. It was a record Cyber Monday, $12.4 billion. That represents 9.6% growth on a year-over-year basis. And it was the best record online shopping day ever. So consumers were really out in force. And you can see you were talking about Amazon, Best Buy, Etsy, and Shopify all higher. The big winner, though, was really Affirm and the buy now, pay later over the last couple of days, up more than 15% on the year, up 240%. It's interesting because I was wondering, how is this so different from credit cards? It kind of reminds me of that 4-installment plan reminds me of a down payment. But you can see investors loving Affirm, Romaine.
All right, well, let's turn to another part of Amazon, the Web Services Division. Bloomberg Technology co-anchor Ed Ludlow sitting down right now with the CEO of AWS. Ed, take it away.
Welcome to our Bloomberg Television and radio audiences worldwide. AWS CEO Adam Zalipsky with me from their big event of the year. And Adam, like three big pieces of news, right? A deeper relationship with NVIDIA on Grace Hopper Superchip, on DGX Cloud. You have next generations of your own silicon, and then you have a chatbot that we'll get to at the end of the discussion. But let's start with the strategy. I think a lot of questions that I get is, what is the differentiation in strategy with what AWS is doing here, deepening its relationship and reliance on DGX Cloud and Grace Hopper Superchip versus what you're doing with the cloud supported by your own silicon?
Well, I think our strategy has been very consistent. It is to provide choice and powerful options at all layers of the stack. So down at the infrastructure layer of what you need to do generative AI really well. As you mentioned, we both have been investing in our own silicon. And then we have had a long-standing, wonderful relationship with NVIDIA. We've been the first to bring pretty much every significant NVIDIA chip to the cloud, including their latest H100 this past summer. And I was really excited to have their CEO, Jensen Huang, on stage with me this morning, talking about an expansion of the partnership with AWS. Bringing their DGX Cloud to AWS. And NVIDIA itself is going to be standing up a huge supercomputer of a cloud for their own internal R&D on AWS. So it's a fantastic expansion of what's really a great relationship that benefits our mutual customers.
Adam, are there still supply constraints around NVIDIA GPUs?
Well, they're very popular, and I think it is still remains true that there's probably more people who want to get their hands on them than actually can, which is one of the reasons why we also announced this concept of clusters for EC2 for chips, and so that you can actually go now and reserve up to hundreds of GPUs for your short-term generative AI needs for things like training models, which can tend to be episodic, and there's really nobody else out there offering anything like that kind of service.
Given that's the case, have you had to shift any customers to Trainium because of the limited supply of NVIDIA GPUs?
Yeah, it's really not about shifting. It's really about customers need different customers need different things. The same customer needs different things for different use cases. And AWS, for this over 17 years we've been doing this, has been all about choice, all about democratization, all about putting tools in the hands of our customers so that they can make the choices about what we need. And so we're also excited that we announced the second generation of our training-specific chip for training generative AI workloads, and that is Trainium 2. And that's going to have up to 4 times the compute performance of the first generation of Trainium. We, of course, have been investing in our own custom silicon for years. We also today announced that we're shipping the preview of our 4th generation of general purpose chip, Graviton 4. I happen to have one with me right here. This is a Graviton 4 chip. We're not talking about it. We're not showing slides on it. It's not future looking like a lot of other cloud providers. Yeah, it is shipping today. And again, our 4th generation. The power is incredible. The price performance is going to be incredibly attractive. And our chips also have incredible energy efficiency benefits, which is really, really important to our customers these days.
Adam, if the chips are as real as the one as you held in your hand and they're shipping to the real world, give us some numbers. What percentage of the AW customer base is using Graviton? And is anyone using Trainium, the existing or future generation, besides Amazon?
Yeah, Graviton has become very popular. I don't think we've broken out numbers, but all 100 of the top EC2, it's our compute service, the top 100 EC2 customers and 50,000 customers overall, are using Graviton 4. So it's incredibly popular, incredibly powerful. And in terms of Trainium, we're seeing a lot of interest, a lot of folks moving to adopt that, as well as, of course, GPU-based capacity. And with Trainium, we've got folks like Databricks and Ricoh and many others that are building and deploying on them. Anthropic that we're partnering with very closely, and is obviously one of the very leading suppliers of foundation models and large language models, is going to be training future generations of their models on Trainium.
On Anthropic, since last we spoke, what's changed is Anthropic's come out and said it's also deepened its relationship with Google on Google Cloud Platform. Is Anthropic using any of your custom silicon to train Claude, or do you have any sort of visibility on a start date of when they'll start training a future model on your silicon?
So really nothing's changed. Anthropic has been running on AWS literally since they were founded in 2021, which seems decades ago, but it was only 2021. And we obviously are providing choice of a lot of different model providers to customers. Many startups, including Anthropic, as they grow, are going to use multiple providers for different things. But I think we and Anthropic have been very clear. AWS is Anthropic's primary cloud provider for their mission critical workloads. And the majority of overall workloads from Anthropic are going to run on AWS. And Anthropic will be training future versions of their Claude models on AWS. They will be collaborating with us to help improve our Trainium and our Inferentia chip technology. And they're going to be bringing powerful features around fine-tuning and customization that for certain periods of time will only be available on AWS and through Anthropic directly, not on any other cloud. So the relationship is deep, it's strong, and it's unchanged.
Adam, will you ever be able to get OpenAI to be on AWS?
I think we are going to try and bring all of the models that people care about onto AWS. We've got Anthropic, Cohere, Stability AI, AI21, Meta's Llama 2 model. I'm sure there will be others over time, and we're just going to be guided by where our customers tell us they care about the most.
So the other big piece of news is an AI chatbot, finally, from Amazon, Q. But here's my question. If I use Gmail or I use a Microsoft piece of software, I can take those pieces of software and use the new AI tools that those companies are bringing to market in their existing suites. Q is on the AWS console. So does that mean I have to train as a developer and become a developer to get access to it?
No, Q is, we're incredibly excited about Q. All the many customers that have been previewing Q in private are incredibly excited about it. And we think it's going to be transformative in helping to reinvent how people work. I mean, the existing chatbots or generative AI assistants are great for consumers, and so many of us, of course, have used them, experiment with them. But unfortunately, for the most part, they don't really work at work. They don't really know who you are. They don't really have access to your repositories. And for the most part, they've lacked security and privacy characteristics that are pretty much requirements for enterprises and many other companies. So Amazon Q is going to be tailored and customized to your business. We've built connectors to over 40 major systems, including Microsoft 365, including Google systems, including Salesforce, Zendesk, ServiceNow, and many others. And Q is going to be able to access those if you give Q access to them, but it's going to respect your privacy and security. If you don't have access to a database without Q, you're not going to have access to it with Q. But meanwhile, it's going to make it so much easier and more convenient to find data, to generate answers, to summarize things, to reach new conclusions, and to get to actual insights and actions. So it's going to integrate really well with the systems that people care about. It's going to be enterprise grade. And again, we're really excited about it because our customers are excited about it.
Adam, I know that you're someone that believes fundamentally choice is important when it comes to AI tools. What work are you doing on the diversity and ethics side here? We always talk a lot about silicon and product, but what about some of the guardrails and safeguards needed in AI?
It's incredibly important. Funny you should use the word guardrails, because this morning here at reInvent, where we have 50,000 people live in Las Vegas and over 300 other thousand people registered around the world, we actually announced guardrails for Amazon Bedrock. Bedrock is our foundation model as a service offering with all those models inside. And guardrails is a new capability which actually allows you to enforce your own responsible AI priorities and policies. So if you're a financial services company, you might have your chatbot not give investment advice. Or if you're a utility with a customer service chatbot or generative AI assistant, you might have it strip out the PII or personally identifiable information from the call summary to respect people's privacy. So we're taking it really seriously to the point of actually building in these leading edge capabilities that really aren't available from other providers. And in addition, it's really important that we're participating in the working groups that are discussing these things. We're going to need a multilateral approach of government, private sector, academics, and more. And I was at the White House with President Biden this summer, where we participated in these voluntary commitments around AI. Earlier this month, I was with the UK Prime Minister Sunak at a gathering where he announced an AI Safety Institute in the UK. And we're going to continue spending time participating in these dialogues.
Adam Zalipsky, AWS CEO, thank you for your time. Back to you guys.
Thank you.
Thanks, Ed Ludlow there. Stick with us here. We're going to set you up for what markets will have their eye on tomorrow. This is Bloomberg. It's been quite a day, Scarlett, of course, punctuated by the passing of Charlie Munger, of course, a longtime business partner of Warren Buffett.
Yeah, and a giant in the investment world and the alter ego to Warren Buffett. Rest in peace, Charlie Munger.